What's up, everybody?
We forgot the flag! What? Misdirection.
Oops, sorry, I forgot to change it back to this here.
Never felt so alive! Okay, look, that wasn't real scary. It was better than what you did. You should have stuck to my strategy. Whatever. Talk to me when we start the real scary.
You guys going to the party?
Oh, I think you got the wrong guys. We don't get invited to the party.
The big kids mixer at the board. This board is all scare team. You were one of us, right? See you there.
You hear that? You can't believe it. Bad idea. This is great. They're finally seeing us as real scarers. We're going! Do young people still dance? Is memory true? No, we forgot to bring the hostess gift. We can't go in there without the center candles. Calm down. We earned this. Well, what if there's a lull in the conversation? I never know what to, say. How do you survive this? You just took on an angry 50-foot librarian. Now you're afraid of a little party? Take a deep breath. And you go.
Is that your new cupcake?
Hello.
Yeah.
It's Super
What you did today was insane.
Yeah, I ate eggs and crackers. A lot of good ones too. You with some oven and then a half a banana.
Tonight we party like
Cookie. Yeah.
Take care, Dad. Oh, Mom.
Ooh, for you.
He likes to play with them.
Yeah. There's another one.
All right, on behalf of the Roar, we'd like to congratulate all the teams that have made this far. Here's the pigs. Love that trick. Never gets old. Hits! Good evening, JP. And finally,
returning to normal here, but as our Eunice found, things are how prolonged in effect is the company likely to feel in China? Any sign of a kind of end there? And are they really starting to feel the impact yet, even in the U.S.?
Right now, we have a lot of news flow that's out there. So as a result, it's hard to get a gauge for what is the real and what is the new normal. Right now, I think you're in a situation where there's a lot of hysteria out there, some of it much deserved, but at the end of the day, the consumer still has a habitual process. They still get their coffee, they're still eating their meals, they're still going to places, whether it's as frequent or not. It's too early to say how long that's going to persist for.
Do you guys, are you able to track traffic like week by week, or do kind of channel checks to get a sense of how much at least foot traffic might be down?
I don't have a good sense for that as of now.
Yeah, I can just imagine that since it's just beginning here, it's going to be some time before we know if we're going through a kind of V-shaped rebound or not. What is your price target on Starbucks? I mean, how would you look to this company to kind of weather this coronavirus outbreak?
When I initiated coverage a number of weeks ago, you had a whole different paradigm out there. We had yet to see a correction in the S&P. We had yet to see any adjustments on a stock-by-stock basis. So I have a $105 price target. That was based on a calendarized 2021 earnings estimate. Right now, I don't have a sense for what the short-term, intermediate, or longer-term algorithm is going to be for earnings on Starbucks or any of the other companies within my covered universe, let alone the macro overall.
So you will adjust your numbers, but you have to wait until you have more clarity. Is that right?
Right now, we don't know if the fundamentals are going to change for companies. We don't know if the market multiple is going to change. We don't know how the investor sentiment is going to change. But at the end of the day, where I'm positioned is I still think Starbucks is a strong company that has long-term growth. It has solid unit level economics. It has the ability to use some of their streamlined operations where they have a channel distribution business so people can still drink their coffee at home. They have an international presence that can offset some of the domestic business if there is a prolonged hiccup in the short-term results.
One more question for you. You today happened to kind of put out a note there looking at the different delivery models for a lot of the restaurant companies that you also do cover. Could that be a potential upside in the sense if people go, you know what, I better look to delivery to get my food to me. I don't want to go to a crowded restaurant. Who do you think might best capitalize on this kind of spark of interest in delivery from restaurants they might have previously thought about?
I think we're not going to just look at it from a delivery standpoint. It's the entire off-premise business. You have a number of companies, whether they're the full-service restaurants, that are now seeing mid-teen percentages of their business going out of the door. So that's either picking food up or it's a delivery model. You have the limited service players, many of whom do 2/3 of their business through the drive-through, but they've also expanded on delivery as a potential driver. What we may see is we may see some shifts if this persists and people are afraid of being around people. But at the end of the day, America still will find a way to eat. We know that grocery stores right now have been seeing a little bit greater of a run in terms of traffic and stockpiling. But at the end of the day, even if consumers are staying home, even if consumers decide not to commute, there's still going to be there's still going to be either a need to go out and eat because you want to break up the hibernation, or there's going to be the need to bring food in so that the consumer is fed.
Yes, and they'll benefit from that in the long run. Brett, thanks for coming in. We appreciate it today.
My
Brett
pleasure,
Levy
thank you.
from MKM Partners. Now, as the coronavirus continues to spread, many conferences and meetings have been canceled. Employers are putting on travel restrictions, and a lot of people are telling employees, look, just work from home. Given all this, Uber and Lyft, who rely on consumers being out and about, well, the companies remain very bullish. The Lyft CEO saying yesterday that demand in ride-sharing remains extremely strong during coronavirus, and the stock was up big yesterday as well. And Uber's CEO saying it's not material for the company overall, adding there's nothing that's harming and nothing we can't adjust to. Let's bring in Dan Ives. He's an analyst at Wedbush Securities who covers Lyft, among other names. Dan, it's good to see you today. So these companies have been back and forth. Yesterday, it seemed like maybe the coast is clear. Today, not so much. But if people aren't traveling from airports as much, I mean, undeniably, there has to be a hit to that portion of their business.
Yeah, I mean, look, no doubt. And they're really sort of poster childs in terms of this broader coronavirus, tragic outbreak in terms of how it's going to impact travel. And the thing about the timing, this is just when Uber brings up profitability target a year. Lyft is sort of in the penalty box here. I think they had to come out, if they believe that it was not going to impact numbers. But I can tell you from investor calls, constantly the last 72 hours, the debate is trying to put goalposts around, is there risk? I think right now it's too early, and I do view it as more of a short-term shock. But no doubt right now, this is definitely a heightened risk for those names in terms of where they play.
I wonder, Dan, if the bigger issue, the front page of the Journal today talks about how France has now come out against the, independent contractor business model for ride sharing. So you've got France, the UK, California, all lining up and saying, no, these have to be employees. Maybe that's the bigger problem.
Yeah, no, to us, the darkest cloud over these names right now is AB5 from California. The ripple effect to New York, to Massachusetts, and obviously over the pond. Look what's also happening in London as well. That really is what's a potential gut punch, not just Uber, Lyft, but just the overall gig economy. I think that's still what I view as an $8 to $10 overhang on Uber stock in particular. We think it's not going to be as draconian as feared once it kind of plays itself through the court systems. But I do think you kind of take that, combined with what we're seeing on some of the nervousness around global travel, that's sort of the 1-2 punch that's making these names just so volatile, especially after Uber and Dara just raised profitability targets up by a year.
That's true. Maybe perhaps makes that a little harder to achieve. Let me ask you about Slack, ticker Work, which is another company you cover. A lot are saying this could be part of the basket of stocks that does better. People working from home, relying on these messaging systems. Do you see any evidence that this company will be helped in the long run by this trend?
Yeah, obviously Slack continues to sort of be, it's a great company in terms of where they play. Microsoft, is the main competition, but I think they do play into that theme. And I think that's something that I've definitely seen a shift of investors wanting to play more names that could play into that trend, like a Citrix maybe as well. I think they do play into the trend. I think it's going to be key over the next week with earnings to sort of see, do they call it out? Is there a bump? Right now, no doubt sentiment's improved in Slack, but I still think Microsoft competitively, just looking at longer term, continues to be a major risk as they go into Redmond's turf.
Yeah, fair enough. We appreciate it, Dan, today. Thanks for your time.
Thanks.
Dan Ives, talking about ride sharing and Slack. Now, customers at grocery stores nationwide are seeing some empty shelves in place of cleaning products and non-perishable items as they stock up in light of the coronavirus outbreak. As you can see from some of these images behind me, Kroger is surging more than 8% today, having its best day of the year. For more on how the supermarkets are responding, I'm joined by Anthony Hucker. He's president and CEO of Southeastern Grocers. That's the parent company of Winn-Dixie, Bi-Lo, Harvey's, and Fresco y Mas, with more than 500 locations in the region. It's great to see you, Anthony, and while coronavirus isn't that bad yet in your part of the country, are people already destocking your stores?
Yeah, it's great to be back, Kelly. Thanks very much. Yeah, we've seen an uplift of traffic and transactions across the whole store as people are eating out less, but particularly in the areas, obviously, of household cleaners, air fresheners, personal care, toiletries, Kleenex sanitization, if you will.
So what are you doing in response to that? How confident are you in being able to keep those shelves full?
Yeah, Kelly, unfortunately, we live in the footprint where there's a lot of natural disasters. We've had 4 Category 5 hurricanes in the last 5 years, and there's only been 35 on record. So we are very prepared for these types of situations, and there's similarities between the category lifts from preparing for a hurricane as we are for this danger to public health.
How would you actually, it's interesting you bring up the hurricane analogy, and many are drawing the connection between a natural disaster and an event like this because we're seeing runs on similar kinds of products. How would you describe coronavirus on a hurricane scale so far?
Yeah, the similarities are that you typically get a 3 to 5 day warning, if you will, of any imminent weather impact, and this is very serious. This is very similar. We have a kind of 5 to 7 day lag, particularly because 80% of the cases of coronavirus are on the West Coast. So we have a world-class supply chain that's constantly in touch with our friends and colleagues on the West Coast to see which products are moving.
So here's my question for you. When a natural disaster happens, the affected region is devastated, but the rest of the country is humming along just fine. What happens when the entire country, is running for toilet paper, and cleaning products? Is there anywhere left to turn to make sure that you can draw those supplies when you're competing against now all the other grocers in the country and not just those in your area?
Yeah, again, we have a world-class supply chain, so we're very used to watching the movement of product, and right now, as we stand today, we're fully in stock. There's, again, similarities between the categories in terms of personal care, home care, sanitization, so we're very well stocked.
And can you explain how that is, what that world-class supply chain means? Does that mean you rely more on American companies, or are you diversified globally? Are there, multiple, what does that actually look like?
Yeah, we are predominantly American-supplied companies. In fact, I just came to visit with you now from our annual supplier summit here in Jacksonville. So we have 1,000 of our largest suppliers actually visiting here right now. So again, we're used to watching the algorithms, and when products are pulled at a faster rate, we can change those fields from our computer-generated ordering system to make sure that we're serving our customers.
So you think shoppers in your region will have no reason to stock up ahead of time? They're going to be able to get the product they need from your stores?
Yeah, absolutely. I mean, they are stocking up right now. In some of these categories, we've had over 200% lift. But again, the supply chain is very, very robust, and we're well practiced in the muscle of disaster relief.
All right, Anthony, thanks for joining me.
Thanks a lot, Kelly. Thanks
Anthony Hucker is the president and CEO of Southeastern Grocers. And stocks are selling off sharply again today. The Dow is down nearly 3.5%. It's down 911 points. Similar declines to the S&P, the NASDAQ, the Russell today. The yield on the 10-year hitting a new record low, breaking that 0.9 handle. Double Line's Jeff Gunlock says the drop in yields could be over soon. Listen.
I think we're pretty near the low right now. I mean, maybe we'll get to 80 basis points on the 10-year. I don't really believe in the 25 basis point 10-year. I think that's just extrapolating the move that's already happened. I mean, I think that the short rates are definitely going lower. There's absolutely no upward pressure on short rates, but we're starting to see a steepening yield curve in a way that's noticeable.
Joining me now from the floor of the New York Stock Exchange, talk about how they're handling the volatility, Virtue Financial's Matthew Cheslock. From the bomb pits in Chicago, Jim Urio joins us as well. He's of TJM Institutional Services. And Matt, I'll begin with you. What are you watching in these markets for a sign of whether we're bottoming out here at all or not?
Well, the 10-year, obviously, when it holds above 9, that's a positive sign. Yesterday, it broke through 1 late in the day, and we had that further added on to the rally that we saw. And that was kind of, we were kind of optimistic that might have helped, but that certainly hasn't been the case. When you start to see, a 10% move in the 10-year yield in a single day, that's only 10 basis points. This market is moving very fast right now, and equities just can't keep up right now.
Do you get a sense, Matt, especially being in the middle of things, about is it all algorithmic and programmatic, or is there, kind of the good old-fashioned battle of viewpoints in terms of the trading community and investors out there?
Well, I don't know if there's enough clarity for people to invest. I think right now, the transports, for one, are almost uninvestable right now as far as from a trading standpoint. Energy has been suffering from that same kind of malaise. So right now there's certain sectors that aren't seeing, anything. We're seeing all the money flow into gold. We're seeing into telehealth, teleconferencing. All the money is being moved out, and they're being moved into the same sectors at the same time. So it's kind of hard to fight that tape.
Jim, let me bring you in on that. Watching oil, watching gold in some of these sectors, what message are you getting from there? I mean, as sharp as this sell-off has been, talk through what each of those themselves seems to be doing.
Well, you and I talked about this a week ago with gold and 10 years, because I thought the response to this, to the economic effects of the virus, is going to be central banks just turning on the spigots, ever increasing. And we've seen that happen. And I think it's going to end up in gold, and I think it's going to end up in 10 year, and it has already. The gold had that weird margin call related 100-point drop last week, but it seems to have recovered that fine. So I think that thesis is still good. Now, the thing with stocks, it's the virus versus the Fed. Right now, the virus is winning, but until we make new lows from where we were last week, I'm not particularly worried. I think this is part of a bottoming process. And the thing that's different about this fight to me is that it does have a clock. It has an expiration date. The flu season generally lasts here between December through March, sometimes extends into April a couple weeks. So if it can fight to a draw till then, and we're less worried about the economic impact, and that central bank liquidity is still sloshing around out there, I think that's a recipe that's good for stocks. So again, not in the short term necessarily, but getting close to where I want to be in again.
Matt, what are people looking for? Is it, another thing that Jeff Goodman was talking about was that the market now, he thinks, or he was saying he himself wants a half-point rate cut from the Fed at the next meeting. I mean, what kinds of expectations are we building here?
Well, now we're expecting at least a quarter point when they meet in March 18th, so that wouldn't be a surprise. I think the bond market is building that in. Once that happens, maybe we do reach the bottom there. Maybe the boat becomes a little too overcrowded as far as people buying bonds. Maybe they turn to equities at that point. So, again, I don't know if we're going to get any clarity as far as the coronavirus and the threat that it poses long term. I would imagine the cases will increase dramatically as testing increases, but certainly, what we need to find is some kind of bottom here in the bond market, as far as the yield goes. It's really not equities just yet. I mean, we still could slosh around a little bit lower here. 30, 50 in the S&P was an important number today.
Yeah.
We kind of held that for a little while. We broke through it. We saw further deterioration to the downside. So the technicals are very fast.
All right, guys, hang on one second. Ylan Moy has some breaking news for us. Ylan, what's going on?
Well, Kelly, the Senate now has the votes it needs to pass a roughly $8 billion emergency funding bill to respond to the coronavirus. The current vote tally is 63 senators in favor. No senators so far have voted against it. This is expected to pass overwhelmingly, as it did in the House yesterday, and then it would be able to move on to the president's desk. Now, earlier today, lawmakers have been briefed by administration officials on the status of the response to the outbreak. They were told that there could be 1 million test kits available in short order. This bill will provide not only federal agencies, but also state and local governments the money they need to purchase those kinds of kits. Again, the vote is still ongoing, but is expected to be a show of strong bipartisan support. Kelly?
Ylan, thank you very much. Ylan Moy on Capitol Hill with the latest there. I'll turn back to Jim Iuorio, sir, for a quick response, kind of your reaction to that news, and put a button on it here.
No, I think it's great. Anytime we can see them working in a nonpartisan way, I think is wonderful. And sometimes it takes these sort of things to do that. I think that's encouraging. You talked about the Fed lowering rates again. And there's so many people out there, it's become fashionable to say, well, lowering rates doesn't help this virus. Yes, but it can help the economic impact of it. There's plenty of companies out there that are going to be affected greatly. Some companies that operate on very low margins and might not be able to withstand it. And a little extra boost from lending could be a very good thing. So I'm for them lowering rates in situations like this. What I'm not for is them not taking away the punch bowl when they should, which will probably be a couple months down the road.
Have you guys stocked up on, TP and everything else, Jim, at your house?
I have not. I'm not that much of a believer in this. And please, nobody trust me on this because I don't know anything. But I'm not that scared about it. Sorry.
No, just curious. Jim, we really appreciate it. Thank you, sir. Jim Iuorio out at the CME. Matt Cheslak's down at the New York Stock Exchange. That does it for the exchange today. See you on Power Lunch.
Kelly, thank you very much, and we'll see you over here in just a moment. Welcome, everybody, to Power Lunch. I'm Tyler Matheson, and we start with another major sell-off on Wall Street at this hour. As you see, the Dow is down almost 900 points. Stop me if you heard this before. Stocks are tanking as fear of the coronavirus front and center in investors' minds. Check out the Dow. The lows today down more than 1,000 points right now, down more than 900 following yesterday's huge relief rally. And that fear, of course, bleeding into the bond market as well. The 10-year yield hitting a fresh record low, breaking below 0.9%. That is a staggering move right now at 0.928, but it was lower than that earlier. And we now have about 177 cases of coronavirus in the United States as the CDC begins to roll out more testing across the country. Washington State dealing with the largest outbreak so far. Cases doubling in New York. We'll tell you how bad things could get as Power Lunch begins right now.
Thanks, Ty, and I'm Kelly Evans. We're all over this virus volatility for you today. Our team coverage of this market sell-off rolls on as coronavirus fears do grip Wall Street once again. Bob Bassani is tracking the action down at the NYSE for us. Rick Santelli watching these amazing moves in the bond market. Meg Terrell with the latest on the outbreak. And Steve Leisman digging into a potential credit crunch coming for corporate America. Bob, we start with you.
And the debate has always been for the last week or so, is this a short-term phenomenon for American businesses and specifically earnings, or is this a longer-term phenomenon we're going to be dealing with for several quarters? For today, the concerns about longer-term are definitely prevailing. Here's the three sectors that would be most affected here. Energy and industrials, all notably down here. Banks are also weak on top of that. You see gold rallying here. We're sitting here multi-year highs for gold. Notice China, this is a broad China market, is up. There's been hopes, been looking at maps indicating pollution levels are back up in China. Maybe people are going back to work. Okay, maybe that's a little bit of a hopeful sign here. But not if you look at this whole demand side. We're debating supply versus demand. Folks, look what's happening. These are new lows, new multi-year lows in all of these sectors. Royal Caribbean, Marriott, Delta, Live Nation, concerns about lesser participation in entertainment. Madison Square Garden also down. As well. Just take a look at some of the banks as well. As you can see here, these are new 52-week lows here on all the big banks. These are big super regional banks, including Wells Fargo, all new lows. So why the chaos and what's going on? Remember, essentially we are debating whether or not there's going to be a recovery and what it's going to look like. Is it V? Is it L? Is it U? And nobody can answer this question right now. We don't have enough data. Indications over in China are hopeful. Europe is still a bit chaotic right now. That's sort of in the middle of the whole debate. As for the supply versus demand, forget about it, folks. This is both right now. It's a supply problem and it's a problem. Demand problem. Just ask those people that are in the entertainment business whether this is a demand problem or supply. They don't care. Guys, back to you.
All right, Bob, thank you very much. Let's go to the bond market now, where yields are just collapsing as the 10-year hits an all-time low. Rick Santelli, live at the CME with more. Hi, Rick.
Hi, Tyler. Just looking at the yield curve today, and net change gives a lot of information. 2s are down 11, 5s are down 11. We're down 14 in 10s, 13 in 30s, so the curve has a bit of flattening because the drops are bigger in the long maturities. This has been the oddity. Mostly it's been steepening with short rates outpacing the drop of longer rates. 2-year note yields at their worst at 55 basis points. You see on that chart would have been the worst close since July of 2016. They're up a little. It really isn't going to change the comp. Intraday of 10s is alluded to by Tyler. 0.89, there it is on the right side of your chart. That is the low, at least for today. And how do you make a bounce to 1% look good? You start at 0.89. 1-year boons, they settle at minus 68, minus 71. Late August of last year was their all-time low close. We're within striking distance. Finally, the dollar index intraday. You see where it's trading? Right now, it is under 0.5 cent from unchanged on the year, which was 86.39, and it would be the first time in 2020 we challenged that level. Tyler, back to you.
Rick, thank you very much. Well, the major averages seeing their second steep drop in 3 days after yesterday's big rally. The second biggest point gain for the Dow ever after Monday's. The Dow falling back into correction territory right now, down more than 10% from recent highs. So are we heading back to Friday's lows? That's the question for Jason Pride, Chief Investment Officer of Private Wealth for Glenmead, which is more than $40 billion in assets under management. And Tim Seymour will join us for the hour. He's the CIO of Seymour Asset Management and a CNBC fast money trader. Welcome to both of you. Jason, let me start with you. What do you think the headwind is here for global GDP and potentially corporate earnings?
Sure, Tyler. So, we have to recognize first and foremost that you could basically drive a truck between the upside and downside case scenarios here because nobody has a very good beat on how long this is going to last per region and how governments, corporations, or individuals are going to react. Now, having said that, if fair heads prevail through this pattern and we try to minimize damage while also trying to deal with the disease in ways that we've dealt with other outbreaks in the past, we should experience somewhere around 0.5% to 1% headwind to global GDP growth. Now that's based on assuming that China took its hit and that is what it is and it has to pass through the system, and everybody else that's affected takes a smaller but still notable hit along the way in trying to rectify the situation and slow the spread of the disease. That is part of what the markets are reflecting. I would argue that markets may be over-reflecting a bigger chance of bigger downside at this point in time, but time will tell on that as we process along through this.
Tim, do those numbers sound in the ballpark to you? A little too modest? A little too grave? What do you think?
No, I think for first quarter GDP, if you look to the main economists on the street, people have cut down. UBS is down at 0.06. You've seen people cut it to the bone. Bruce Kasman at JP Morgan, I think, is pretty much right down the middle at 1.2. the bottom line here is we had risks to global growth before the coronavirus. So if you think about Europe's economy, think about the biggest economy in Europe, which is GDP, and the export route into China, what was happening with the trade war. PMIs around the world throughout the fall were essentially caving, and then we were wondering where we were starting to see a little bit of a bottom. We were. The dynamic here isn't great, and I think that's what equities should be grappling with, because if you think about where we were on those lows of October 3rd, before the markets then went up 19%, a lot of that was Fed liquidity, and I think markets would have been grappling with the same things we're grappling with now with the coronavirus.
And Jason, in terms of liquidity, let me just go back to the question about whether providing more liquidity, acting as a lender of last resort, lowering the rate, are all of these things, you think, fundamentally going to help the U.S. economy, or do they risk doing more harm than good?
So number one is I'd say there's two problems to fix. One, which the Fed and liquidity has no solution to whatsoever, and that's the actual outbreak of the disease and any ramifications that come from that, and any shutdowns that governments have to do regionally and otherwise. The economic impact of that is going to be what it is, number one. But number two, what they're trying to avoid is a seizure of financial markets and credit markets that could be a second order impact here. With the central bank stepping in, they try to avoid that situation and try to keep this from spiraling to the downside out of control and having kind of second order knock-on effects that take this down further. Long-term impact, look, low rates, ongoing fiscal and monetary stimulus. Eventually, we have to get out of that trap at some point in time. We need it right now at this instant. What they need to do is once things get back online, they have to take that away at a reasonably fair pace in order to get us back to normal operation down the road. It's just we're not near that right now.
Do you see, Tim, signs of the kind of financial panic, the kind of crunch-esque situation that he's describing? I mean, we see empty store shelves. We see people trying to get their hands on toiletries and supplies. Do you see a financial market analogy there?
Well, so I mean, the panic around getting supplies is largely things we've seen. This is an extreme version of that around macro weather and certain events. I think the financial markets are, you can make an argument that the bond market's panicking. The bond market is certainly forcing the Fed here. And I would argue actually that rates this low is detrimental to the economy. And this creates tighter financial conditions, not looser.
Why?
Because ultimately, first of all, banks start to reel in credit. And at these rates aren't moving lower because of people are buying debt out of confidence in the growth story. They're going lower as a safe haven. So the credit dynamic, and if it was 9 months ago, we were talking about this tranche of kind of BBB plus. That was really that concern of going to junk, or BBB minus, I should say. So, that big part of the credit community, and we've actually seen credit spreads be reasonably well behaved. But we've just started to see companies give you their guidance, and the sectors that we may talk about later on this show are ones that are they're a lot closer to credit stress than I think people know.
Energy being one of them, yeah.
So, Jason, here we are in the first week in March. In the first week in April, a month from now, corporations are going to start reporting their earnings. Would you expect that would be a time where we might take another major leg down as both the actual reports and the forecasts get revised?
So I think I have to go back to my earlier statement, is that the range of expectations is really, really wide on this. I would argue that we started the year at 9.4% growth for the S&P 500 expectations for 2020. We're already knocked back to about 7% as companies have already initially started to kind of guide lower, or analysts have already started ratcheting down numbers. I would expect we probably end up seeing somewhere around 0 to 5% growth for 2020 as being kind of ultimate results. So. But I think markets are already kind of baking that in. The question that creates the further leg down is if the downside case gets realized at this point in time, meaning prolonged virus contagion and outbreak and or second order impacts on the market. Those are not our base cases, but they are in the realm of possibility, and we need to be aware of them as investors.
What is the risk, Tim? Jason sort of alluded to it, that the financial system could seize up. This is not a financial crisis right now, that I can tell, like 2008 was. But are there risks Or it's not even close.
It's not even close,
It has no,
especially in terms of
completely different origin.
The sovereign balance sheet's in a very different place. It's not in a great place. The corporate balance sheet's in a quite good place. In fact, the earnings support for the market for the last couple of years has been buybacks and the ability to actually raise debt at low rates and do other things with it. If you look at the balance sheet of the banks, look, the money center banks have never had better balance sheets. Their risk models have been reeled in dramatically. I think a lot of this is market positioning. I think a lot of this is we came into this with $400 billion of Fed balance sheet that was thrown at the market, which correlated 1-to-1 in terms of the S&P move. You have an expectation. Bob Pisani at the start of the segment talked about, are we V, are we U, are we L-shaped recovery? I think he was talking economic. I think people think that that's the market. I think people think the market, after December 2018, a lot of people were burned sitting on the sidelines, and it was a V-shaped recovery, and it was a place where you should have been buying with both hands. And I'm not saying people should run for the hills. I'm saying that you can argue we're in the same environment. And even though there are great companies right now that I think are worth owning, and I'm sure we'll talk about them.
You want to mention a couple and then we'll move on?
Yeah, I mean, Disney is a company to me that was re-rating on the back of essentially their Disney Plus service, has a studio business that's been cranking for a couple of years now. And yeah, I understand that their theme park and their consumer experiences business is 38% of the revenue line, but in the short to medium term, that's a headwind for a company that we were re-rating and actually using a hybrid multiple on all these other drivers. Disney is trading inside of where it went before it re-rated. So there's a good example.
All right. And Tim, like you said, is sticking around for the hour. Jason, thanks so much for joining us. We appreciate it. Jason Pride of Glenn.
Thanks for having me.
Well, our next guest says there are 3 scenarios for what happens next as the number of coronavirus cases climbs in the U.S. and around the world. Here to break down what the global economic fallout could look like is Robert Kahn. He's Eurasia Group's Director of Global Strategy. Robert, it's great to see you. You have the benign, serious, and severe. And before we dig into what those are, where are we? Which one are we right now?
Well, for the reasons your panel's been talking about. We're still hopeful that a benign scenario could play out. But I think we're increasingly worried about the more severe scenarios, and that's why we set out to lay out these scenarios and try and differentiate and talk about the critical role of policy, as well as the virus itself, differentiating. We started with the science, by the way, in doing these scenarios. It really does depend, in our view, on when the peak in cases occurs. In the benign scenario, if the frontline states, China, South Korea, Italy, make good progress in coming weeks in containing the virus, and the U.S. and others are aggressively going after it, we are still hopeful. Or still possible that we could end up with a peak in the growth in cases in the next 6 weeks or so. And certainly we believe that in that scenario, you do get the V-shaped recovery, you do get a pretty rapid bounce back in growth, you do get some recovery spending as people go back to work and go back to the theaters. But as I say, we're less and less optimistic that that indeed is going to be what happens, and more concerned about what we call a serious scenario.
Okay.
In the serious scenario, we don't see a peak in the new cases and the spread of this disease until the middle of the year, perhaps July. And that leads to profoundly different outcomes for the global economy, because with a virus and a pandemic that is of that length and duration, the damage to supply chains and to the balance sheets of corporations and households is far more severe. And in that case, we're far less comfortable with a scenario of a quick or rapid bounce back. In fact, in that scenario, we see zero global growth through the middle of the year and only a gradual recovery in the second half. And that would leave, as I say, lasting damage. Really will put the pressure not just on the central banks, where we're focused now, but on the fiscal authorities to come in, provide not just credit facilities, but to make fundamental decisions about who to fail and who to bail. You know, how you provide support for the industries that are being badly damaged by the virus, or simply were overextended and got into trouble given this shock.
So, Robert, do you take any comfort from the reports that the disease or new cases of the disease in China seem to have moderated very dramatically in the past week or so. In other words, they are having sort of lower lows most days in the discovery of new cases. Is that encouraging to you? And if so, how much?
Well, it's certainly encouraging, but I have pretty fat tails in the distribution. Certainly, I'm not a scientist. I'm not a medical professional. I don't even play one on TV. But but we do listen to them very carefully, and the news out of China has been good. I would emphasize, and it's a theme that comes through all our scenarios, particularly the more serious ones, the serious and the severe scenario, that policymakers face this trade-off between a very hard containment strategy and one that perhaps is more focused on identification, tracing, and testing, and gives a higher priority to reanimating the economy once you feel like you got a handle on things. Containment has its advocates, but it does come at a very high economic cost, and we see the Chinese struggling, I think, to get people back to work where they've decided to do so. So, I think our basic view at Eurasia Group is to be very cautious in making any firm medical judgments about the course of the virus at this stage. It's extraordinarily uncertain.
Understandably, so let's talk about central bank policy, because people are immediately looking to that for a bailout here before we even know how severe this is. Does that make sense to you?
Yeah, central banks are going to be the front line. Obviously, they have limited ammunition in some sense, given where we're starting from, but I had no problem with the Fed cutting interest rates 50 points to bolster demand. Yes, it doesn't really address the supply shock element of this, but it does add additional support to demand in the economy, and the combination of supply and demand is unavoidable here. I wish it had been a little better coordinated, but we're living in a G0 world where I think central banks and finance ministries are going to always going to be, in this sense, likely to be acting in a seemingly independent or less coordinated fashion. I think, though, pretty soon we're going to really be turning the focus away from interest rate cuts and more to the credit issues. Perhaps as early as next week, when we get in England, when we get in the UK, we get a new budget, and we may get some action from the Bank of England. I think we've also gotten messages out of South Korea and Japan that credit may be really the next frontier for policy action, and the ECB really can't do much on interest rates. I don't think there too. Some sort of term facility extension is probably where we go. So I think once again the shift will come to providing liquidity from central banks. Now, just one caution on that. When central banks do it, they do it based on the idea that these are solvent entities that they are lending to on good collateral. And that's a great plan as long as you're comfortable on solvency. So returning once again to our scenarios, if you really believe the virus will peak in the next 6 weeks or so, and you're in that benign scenario, your liquidity approach works pretty well. But if we're talking about a peak that only comes in July or later, then the solvency questions are going to be front and center. And ultimately, then we're going to have to pivot to governments and to fiscal authorities to make the call.
All right, Robert, thanks for your time today. Robert Kahn of the Eurasia Group with some different possibilities for the outlook from here.
Well, the coronavirus, of course, the trigger for virtually all of the recent market mayhem. Global cases exceeding 95,000 now, deaths reaching more than 3,200, and there are 11 deaths and 177 confirmed cases here in the United States. Meg Terrell has more on the latest outbreak.
Well, hey, Tyler, the numbers here are continuing to climb, and with expanding testing capacity, experts expect them to continue to do so. Today, a doubling of cases in New York to 22, 8 tied to the Westchester case identified earlier this week. New cases being reported in New Jersey and Tennessee as well. In Europe, more than 4,000 cases, with Italy's the largest, but numbers in Germany, France, and Spain climbing as well. Italy's ordered schools closed, and across the globe, we're seeing India and Iran also closing schools. The United Nations notes more than 290 million students are out of school due to COVID-19, calling the global scale and speed of the current educational disruption unparalleled. In Seattle and King County, Washington, with at least 31 cases, recommendations for those at risk to consider staying home and away from large groups of people as much as possible. Those at higher risk include people aged 60 and older, those with underlying health conditions or weakened immune systems, and pregnant women. Guys?
You know, one question on the testing, which is now more widely available. As I understood, and as doctors had communicated to us, at first, if you even wanted to be tested, you had to prove you had been in contact with somebody who had been to one of these really affected regions and that you had certain symptoms. So it was a high barrier to even getting tested. How low is the barrier now? How much more available are these kits, and are they consistent? And state to state?
Well, the guidelines now are to make this available to anybody who wants to have a test with a doctor's orders. However, the availability of testing is still coming online, so you're probably not going to be able to walk into your doctor's office and demand a test and be able to get one. These are getting rolled out to public health labs. Commercial companies are going to start coming online next week. We heard from Quest Diagnostics today. Their testing is going to start on Monday. So capacity is expanding, but it certainly isn't up to the level that they want it to be at this very moment.
You asked a very interesting question last night. I'm not sure we got the answer, and that is, why has the mortality rate been so much higher in Italy than it has been in South Korea, where there are actually more cases?
Yeah.
What's the difference here?
Well, it's something I've been digging into today with epidemiologists, and really what seems to be happening is that in South Korea, they're doing tremendous amounts of testing. 10,000 tests a day. They've tested more than 140,000 people at this point. So they are probably picking up more mild cases. In Italy, we do understand that testing is pretty extensive as well, but the death rate there may actually speak to some of the underlying conditions and risk factors that put people at risk for severe disease. There's an aging population there that this seems to be hitting hard, and those are the people who are at risk for severe disease and death from COVID-19.
Wow,
Thank you so much.
Yeah, difference between Italy and South Korea.
Yeah.
Big thanks. Worries about the spread of coronavirus and possible supply chain disruptions have people flocking to grocery stores to stock up on daily essentials. Take a look at these pictures from our next guest who visited a Costco in Wayne, New Jersey. Been to that one over the weekend. Yeah, found
So
it.
have I.
So you're the one that cleaned up. Thanks a lot,
It
Kelly.
wasn't me. Yeah, now we have nowhere to go. Anyway, they found, and everyone's taking the baby wipes. Anyway, they found empty shelves like these throughout the store, and the run has helped lift stocks like Kroger, which also reported earnings this morning and is soaring, and Costco, which is higher in the past week amid the sell-off, and has earnings after the bell today, we should mention. Let's bring on Rupesh Parikh for more. He's managing director and senior analyst at Oppenheimer. Rupesh, good to see you. And first of all, can both Kroger and Costco cope with this level of demand for the foreseeable future?
Yeah, I think they can. So I was actually at Costco the past few days, and compared to the weekend, they actually had better in stock. So bottled water is back, some of the toilet paper. So I think Costco is handling their supply chain demands well. And then for Kroger, I would say the same thing. You know, if you give these companies time, they are able to restock their shelves. So I would expect the out of stocks to continue to improve in coming days.
So I guess the question goes back to kind of the long-term benefit that these stocks might see. It's understandable there'd be kind of a one-time re-ratings. People say, you know what, and by the way, they have some backing by Berkshire now, Kroger does, so, and Costco's been one of the better performers. But is there a structural change in the value of these businesses because of coronavirus?
Yeah, I would say there isn't a structural change. It is more of a temporary benefit. But what I think you've seen the last couple of days is investors are seeking more safety, and I would say both Kroger and Costco are more beneficiary of that flight to safety. And if you think of earnings for both chains, if you start to see people staying home at more, especially a chain like Kroger, they would benefit from more in-home consumption, and restaurants would get hurt in that type of scenario.
Hey, Rupesh, it's Tim, and I think you may have partially answered the question because you talked about how maybe it's just a safety trade here. But if you think about Costco and Walmart and even Target to a lesser extent, these are stocks that have re-rated massively over the last 12 to 18 months. And again, there was a little bit more of an earnings defensive play to them. But Kroger today, announced excellent gross margins, and today's numbers had nothing to do with coronavirus. So talk about that. Is there a reason why these companies actually should be trading near the top of a range, independent of the coronavirus?
Yeah, so coronavirus, you're absolutely right. I mean, it didn't really have much of an impact on Kroger's report. They did indicate in February their trends improved modestly, and I think coronavirus will have a bigger impact for Kroger and margin going forward. And then for Costco, same thing. I mean, their report that they're going to report tonight, it's not going to have any benefits from coronavirus. But then their February sales report, which they also report, I think you will see significant improvement in their comps for the month of February.
Are whatever gains we're seeing in these stocks, Rupesh, sustainable as we look at the Dow now down 1,000 points again?
I think these names you'll see continued outperformance, but I would argue, as you look out 12 to 18 months, these coronavirus-related gains would start to dissipate. As we look at what's happening right now, you're going to see a temporary benefit for maybe a few weeks, and then, if you look forward, you may actually start to see a give back. As if you're stocking up on toilet paper right now, you're probably not going to go back to the store and buy more toilet paper in the next couple of weeks. So I think it is definitely pulling forward demand.
What other retailers are in the category of ones that might benefit from what's going on right now?
Yeah, so in my coverage, I would say BJ's Wholesale Club, which also reported this morning, they would be a beneficiary. Sprouts Farmers Market as well. And then in the dollar store channel, a company like Dollar General, which is essentially a grocer, more than 75% of their business is in the grocery category, they could also see a nice lift related to the coronavirus panic buying.
All right, Rupesh, thank you very much. We appreciate it. Rupesh Parikh, thank you. And for more on travel stocks, let's send it over to Seema Modi for today's edition of Trading Nation.
Thank you, Tyler. Travel stocks deep in the red today. Some of the worst performers on the S&P 500. Cruise lines taking the brunt of the pain as a Carnival Grand Princess ship is held off the coast of San Francisco with some passengers displaying flu-like symptoms. The stock now down as much as 50% just this year as the coronavirus spread intensifies. So is this group a no-touch on account of the outbreak, or could there be opportunity? Mark Newton of Newton Advisors, Gina Sanchez of Chantico Global joining me for Trading Nation today. And Gina, you look at the price to earnings ratios of these cruise lines and even some of the hotels, you could say they look compelling.
They do, but I think until we understand whether or not this virus is contained, when in doubt, stay out. That's kind of my view right now. We don't know where this goes, and we still need to figure out what the bottom looks like. And the cruise industry, airline industry, hotel industry, they're not going to be able to recoup this later. These are probably going to be losses that they can't recoup. And, you know, for some places like the airline industry, that is going to put them back into non-profitability. So, you know, I don't know that anything is really attractive right now.
Mark, do you agree? If you look at a name like Carnival, headed for its biggest one-day drop since 2009, what does the chart tell you?
Yeah, technically these stocks still look like an area to avoid in the short run. I mean, we've seen some very heavy volume on the declines. A lot of them have broken down. Stocks like Carnival are down over 60% just since the highs were made back in January 2018, and now it's right near 28, so that's really the lowest level we've seen since 2011. It's almost a 10-year low that's being made right now, so very much a steep drop. Oversold does not necessarily mean buy, technically. It's akin to trying to putt a golf ball down a flight of marble stairs and get it to stop before the bottom, okay? It's just very, very difficult. You take a look at the Dow Jones Transports, and you see the damage that's been done in a lot of these airline stocks as well, and so, you know, this continues to be a very weak group. We've actually broken the uptrend from 2018 and undercut the entire area of lows from last summer. So yes, oversold, but we need to see some evidence of stabilization. And until that happens, particularly if the stocks are declining because of the corona, which doesn't seem to be contained, but if anything growing in many countries, you know, it's really wise to step aside and let this group stabilize.
Yeah, well, you could point out back during SARS in 2002, travel rebounded within 2 months after that was contained. Mark and Gina, we'll leave the conversation there. For more Trading Nation, head to our website or follow us on Twitter at Trading Nation. Kelly, back to you.
Okay, Seema, thank you very much, Seema Modi. For more on the travel stocks, let's look at the airlines, which are also getting crushed today. Now, the industry could face a $113 billion hit from coronavirus. You can see American Airlines shares are down 10%, but even the ARCA Airline Index is down 7.5%. Phil LeBeau is in D.C., where airline executives are meeting to discuss the growing risks. And Phil, a lot of concern out there.
Absolutely, Kelly, because nobody's quite sure how long this fall off in bookings will last for the airline industry. The airlines, by the way, as you take a look at the Dow Jones Transports, the big component within the transports that's driving it down, now hitting bear market levels, it's the airlines, whether it's talking about Southwest or American United. Look, they're all down today, a substantial percentage, and that's because no one's quite sure what's going to happen with bookings, and therefore you're seeing schedule cuts from a number of the airlines. You mentioned the potential global cost impact. Let me state this again, how much it has changed since February 12th. Back then, the International Air Transport Association said it's almost $30 billion. That's worldwide what the impact would be because of coronavirus. Today, they upped it to $113 billion, potentially. That's the potential impact. Earlier today, here in Washington, we had a chance to catch up with Stan Deal, who runs Boeing Commercial Airplanes. And we put the question to him, as airlines are dealing with this fall-off in orders and the financial hit, will it impact future orders? Here's what he had to say.
Right now, it's a short-term effect. Airlines are taking response, putting airplanes on the ground and watching the situation. Long term, though, we see that the demand will still be there.
But you take a look at shares of Southwest. Remember, today Southwest put out its quarterly guidance. It's 8K, and they said, you know what? We think revenue is going to fall off between $200 and $300 million in the first quarter. I was just talking with Gary Kelly, the CEO of Southwest Airlines. He said, look, we're looking at a number of things, whether it's putting off discretionary hiring, whether it's seeing other cost cuts that we could put in place. They're not going to stop traveling. They're not going to stop getting out on planes. But they, like other airlines, like JetBlue, they're looking at their schedule right now and they're saying, A, do we keep it in place? You know, JetBlue's already said that they're going to cut schedule by 5%. Or in the case of Southwest, you look at it and say, look, we're going to hold for now, but if these bookings continue to be as far down as they are, at some point Southwest may have to cut its schedule. So it's a fluid situation, Kelly, but one where the airline industry is looking at this saying, we don't have any guidance in terms of when things will stabilize with future bookings.
Hey, Phil, it's Tim. How about, are they discussing, or, you know, this is naughty stuff, but how about lowering prices? And again, as airline investors, we worry about two main things. We worry about capacity because airlines have never had the discipline before. And we worry about revenue per available seat miles, or RASM. So what do you think on this?
I put that specific question to Gary Kelly, and he says, nope, we're not going to be cutting our airfares, nor does he expect the industry to go on a big airfare discounting schedule. He believes that, generally speaking, the airlines first will move towards cutting schedules, meaning basically cutting frequency. Instead of 10 flights a day for United or American between Chicago and New York, it may go down to 8, may go down to 7. They do not think, and this is Southwest and other airline executives, they do not think that this is a case where people will say, you know what, you drop the fare down to $19, yeah, I'm going to get back on the plane. What they're seeing is it's not financial, it's a case of, especially on the corporate side, corporations telling their employees, you're not going to a particular event. And that's why they are not looking at this and saying, let's just cut fares dramatically.
Yeah, and that's why, again, he says no point cutting the price if no one will get on the plane anyhow. Phil, we appreciate it. Phil LeBeau, Tim, just want to mention, as we see now, United's down 10% with American. If you're an airline investor.
Yeah, I am. And
still today?
I'm long Delta. And here's something that people probably don't want to know. And here is there airlines which have been re-rating gradually for the last 5 years. Certainly they did kind of 3 years ago into a sideways track. And if you look at Delta just on the charts, you know, you've had a range somewhere between 48 on the downside and 62. And it's been a very tradable range for the last couple of years. It's broken through those ranges. And if you look, Delta to me is best of breed. It's certainly got the best balance sheet. It's got the best financial discipline. They had no max exposure.
Berkshire agrees.
They've got a brand. And I think you want to buy it. This chart has broken below what has been at least 2 or 3 year support. And that's, you know, I don't trade on technicals solely, but it's a guidepost and something to think about in terms of timing when you put a trade on.
But in other words, a guidepost that says to you, hey, this is an opportunity, or hey, watch out.
Both. You know, that I think that Delta is on valuation very defendable here, although that valuation probably changes in terms of their profitability in the short to medium term. But that chart has me a little concerned in the short term. I want to watch that.
All right. Ahead on Power Lunch, we're still monitoring the sell-off. The Dow's down more than 1,000 points right now, and more than 50 S&P stocks are hitting new 52-week lows. Plus, OPEC reaching an agreement for a big production cut, but energy stocks are down 30% from their recent highs. Will this help relieve the pressure? We'll discuss when Power Lunch returns.
And now, the latest from TradingNation.CNBC.com, and a word from our sponsor.
Wedge patterns often signal inflection points for stocks. A bullish wedge occurs within an uptrend and consists of two converging trend lines slanted downwards. Conversely, a bearish wedge occurs in a downtrend and consists of two converging lines going up. I'm Lee Bull, and Schwab is the better place for traders.
Contessa Brewer, here's your CNBC News update this hour. Former movie mogul Harvey Weinstein's being moved from a hospital to a jail at New York's Rikers Island. Weinstein has been in the hospital since he was convicted of rape. Weinstein's sentencing is scheduled for next Wednesday. The Director General of the World Health Organization is urging nations to redouble their efforts to fight the coronavirus and telling them this is not the time to give up.
This is not a time for excuses. This is a time for pulling out all the stops. Countries have been planning for scenarios like this for decades. Now is the time to act on those plans.
Health officials are also trying to allay fears that pets can catch and spread the coronavirus. This after a dog tested weekly positive, that's their words, in Hong Kong. Officials say it was likely due to contact with its infected owner. The World Health Organization says there's no evidence that dogs can become infected or transmit the virus. Still, Hong Kong officials recommend that owners avoid kissing their pets because, you know, they don't want the pets to get it from the humans. We are the problem. You got that?
Tim's got it. Contessa, thanks very much. Contessa Brewer. We are near the lows of the session. The Dow is down about 1,000 points. The S&P and NASDAQ also tanking today, and the Russell 2000, the small caps getting hit the hardest. There's a look at your screen there. Russell 2000 is down about 3.9% right now. NASDAQ's down 2.9%. We'll call it the outperformer. But it's all eyes on the 10-year yield today, hitting record lows earlier in the session. It went below 0.9%. We're just a hair above those levels right now, 0.926. And oil closing lower despite OPEC looking to secure a 1.5 million barrel production cut. The deal is conditional on one country in particular fulfilling its end of the bargain, and that's Russia. Brian Sullivan has more.
Yeah, so OPEC met today, the OPEC Plus tomorrow. Much different meeting, no meeting. I'm sitting here. I'm not in Vienna. They have a deal in principle. It's not a deal. It's a proposal to cut 1.5 million barrels a day more than they already are. They're 2.1 off their quota. So that'd be at 3.7 million barrel a day.
Expectation was 1 million? I mean,
1 million was like the, if you don't do a million,
got it.
Look out below.
A safety cut.
If we don't get Russia to join on to this 1.5 million, look out below. Because from what I've been going back and forth with people at the meeting, there is no plan B. So if Russia does not get on board, most traders I talked to this morning suggest we could end tomorrow in the high 30s for oil. In other words, oil will tank tomorrow unless we get that
What's
deal.
the read on what Russia wants? They may know.
Look, I was the guy that lived in Russia for a couple of years.
What does Vlad want?
Well, I mean, in terms of production and in terms of swing capacity and in terms of a budget break-even, Russia needs this cooperation more than anybody. Historically, Russia's been a little bit more tactical, but the cooperation between OPEC and non-OPEC over the last 3 years has been almost unprecedented. So
it is, and it's the new OPEC, really. And by the way, Ecuador quit today, OPEC, so maybe Russia could take their spot. Because remember, Russia's not a full member. Russia's the kid that wants the cake and eats it too. You live there, as you said. They want higher prices, but they don't want to be the ones to cut production. And remember, Alexander Novak, who's a very nice man, I've talked to him, the Russian sort of energy minister, he calls Vladimir Putin. He's not making the decision himself.
This is the state enterprise. So the question is really also on compliance, though, because Saudi Arabia seems to be the one that has to eat essentially all of what is non-compliant and do it for the entire group. And at some point, I realize they're transitioning to a 2030 economy that's away from oil and gas. But right now, they're nowhere.
You remember Oprah Winfrey, and you get a car, and you get a car, right? It's OPEC. You're going to cut, and you're going to cut, and you're going to cut, because you're right. Saudi Arabia is the only one that seems to bear this. They've got a new energy minister. He's one of the sons of the king, a lot more powerful in many ways politically than his predecessor. He doesn't want to have to eat all this. But remember, Libya's gone. They're pretty much offline. Venezuela's one ship a day at this point, if that. And by the way, they got piracy now. The one ship a day that's leaving is getting boarded by pirates. Had a captain killed a couple weeks ago. That's how sad the situation is there. So bottom line is this. No deal tomorrow. Possibly look out below for oil prices and these beaten up oil stocks.
On that note, Brian, stick around. We're going to be joined now from Houston by Andy Lipow. He's president of Lipow Oil Associates. Andy, what do you think of what Brian just said? No deal tomorrow, look out below. And how far down is below?
Well, I agree with Brian completely because that's my feeling. If OPEC does nothing, that's the nightmare scenario for them. And the first stop is going to be a WTI with a 3 handle on it. And you know, could go down to $35 a barrel.
Right? Yeah. I mean, it's it could really fall.
Good stuff.
Into the 30s,
Exactly.
you think? Yeah.
Oh, yeah, I don't think there's any doubt because the demand destruction that we're seeing out of China over the last couple of months is 3 to 4 million barrels a day. And the deal that they're talking about right now is only to increase production cuts for 3 months till the end of June 2020. And they have said nothing about extending the cuts that they implemented back in December of 2019. So the world happens to be quite awash with oil due to this demand destruction. At the same time, that oil production continues to increase, although at a slower rate in the U.S., but as well as in Brazil, Guyana, and Norway.
Yeah, Guyana's a big story, by the way. I mean, they've got an election there. Hess, they've got a huge operation there with Exxon, and that's been one of the bright spots. Andy, is there any indication that we're starting to see production finally start to slow in the Permian Basin and the Eagle Ford Shale?
Well, I don't think we've seen it quite yet. We've seen it, say, in the amount of drilling rigs that have been taken offline, but we still see increases in oil production. You saw that in the latest EIA stats where production in the U.S. rose to 13.1 million barrels a day. I guess the good news for the producers is we now have all this pipeline infrastructure to deliver it to the Texas Gulf Coast and make its way into the export market.
Well, maybe good news for those producers, but it goes back to the oversupply issue that's dogging.
Well, yeah, listen, before the December OPEC meeting, I came on, I said, OPEC is our friend. For 40 years, OPEC was the boogeyman, widely hated, right? 4-letter word. OPEC is our friend. I know it sounds weird, but if OPEC, because they are, you know, sort of a cartel, if they can get prices up, that's the best thing that can happen to some of these beaten up U.S. producers.
Yeah, absolutely.
One of the Andy, real quick, is the CapEx hole that this industry either is going through now or will soon face, is that ultimately the best news for prices, though? I mean, and how long does that take? Because the industry has not been reinvesting in itself, and at some point, that's an issue for supply.
Well, it's probably going to take 12 to 18 months to see it on the supply side, but there is no doubt that CapEx is being cut drastically as we speak. In fact, I believe Exxon just came out and said that they're cutting down and slowing down their drilling in the Permian Basin as well. But the fact is that every time OPEC acts to reduce supply and prices rise, these producers in the Permian Basin just get antsy and want to drill another hole in the ground and get more oil out.
All right, Andy, we're going to leave it there. Andy Lipow, we thank you. Brian, great to have you with us as always.
And all but 2 S&P sectors are trading more than 10% below their recent 52-week highs. As overly leveraged industries feel the pressure, do investors need to worry about a potential credit crunch? Power Lunch is back in 2. Welcome back. More and more companies are warning the coronavirus outbreak will hurt their bottom lines, including those carrying heavy debt. And now top credit agencies are starting to sound the alarm. Steve Leisman is here to explain.
Kelly, thanks. Top executives at all three major credit rating agencies, Moody's, S&P, and Fitch, tell CNBC they're closely analyzing the potential effects of the coronavirus on corporate, municipal, and sovereign debt. Moody's says, quote, definitely something that we're monitoring very closely. S&P says there will be more ratings actions and the pace will quicken as a result of the virus. S&P already has changed 27 debt ratings, including 7 downgrades and 15 companies placed on negative credit watch, all related to the coronavirus. The debt's attracting the most scrutiny. Airlines, some airlines with weaker balance sheets, other companies in travel and tourism, they downgraded Samsonite and Sabre, put them on credit watch, and countries that rely on those revenues to service their debt. Commodity companies also being watched carefully, along with countries that rely on commodity revenues to service their debt. The main worry, not investor grade at this point, but speculative debt and highly leveraged corporate bonds, and that should raise a red flag for investors that are going down the credit ladder hunting for yield. Fitch writes, as the virus spreads to other economies, including the U.S., a greater number of leveraged corporates may find their production disrupted and their revenues pressured. We're a long way from the type of debt meltdown that marked the financial crisis, but for some individual companies and countries, probably not so far away from debt downgrades by the rating agencies.
But there's probably an important distinction to draw here. Anytime markets are freaking out, we use terms like credit crunch, which is there's a difference between the quality of the credits in the market and the ability of companies to access credit in the market. So you're talking about the former, not the latter. In other words, you're talking about
at this point,
the quality of those companies
at this point,
not necessarily
right.
whether there's enough, liquidity in the system.
There's a lot of debate, and I'm sure Tim can talk about this, Kelly, about what liquidity is. But more than anything else, it's just state of mind. Liquidity is available and plentiful until it's not. And that's why we have to be careful. It's why investors should just be careful of things that are too good to be true. A massive dividend yield of 7% should raise a red flag. It may be a great bargain.
Yeah, I totally agree, especially on equities. I mean, the massive dividend yield equity companies, the Macy's of the world, are companies that are largely broken. All it takes is one bad day. And back to liquidity, Steve. I mean, this is a Wall Street dynamic too. I mean, think about the liquidity and the dealer community and the balance sheets. They're no longer putting balance sheet at work every single day. So when you call up your dealer and you need a quote in a difficult market, 15 years ago, you got it. And, they widened out the bid ask, but now it's, hey, we can work that for you. But in some level, even some lower high grade stuff on a difficult day is treated almost like by appointment. And that's very challenging in this environment.
You have to be, on the other side, what the debt agencies have told me is that, look, you have credit, you have interest rates coming down. And while spreads come up, interest rates come down, that does ease the cash flow. Also not crazy to think that, for example, some sovereigns might be eligible for bailouts. They mentioned to me the Maldives as a low-grade credit that is substantially reliant on tourism dollars.
Do we need to go there, by the way, just to make
we
sure
may have to go check it out. But the IMF and World Bank have put out the welcome mat for countries to come to them to help with their sovereign debt. There could be other bailout programs that may rescue other companies down the road. You've got to be very careful about which are the weakest ones. And the other problem, Kelly, is that when stuff like this happens, you find out basically where bodies are buried. Who holds the debt? Who holds the risk? And is that person or that entity able to hold the risk, or are they also stretched out?
I've also just heard, because the covenants were written so loosely, I guess we should say, for years, that it's probably the case that when defaults happen, they're going to happen because there literally isn't cash flow to make payments.
Mohammed Al-Arian is worried about the result of many, many years of light covenants and plentiful and cheap money, and finding out just how light those covenants were.
And fallen angels. I mean, those are the ones that are the biggest risk that people don't expect.
All right. Steve, we appreciate it. Steve Leisman, thanks very much. Still ahead, shall we? Over to Ty.
It's been a wild week for the Dow, it says right here. 1,000-point moves, higher, lower, in between. What does all this volatility mean for your 401k and your savings? We'll hear from one of the nation's largest retirement planners after this.
insurance.
Well, 1,000-point swings in the Dow nearly every day the past 2 weeks, putting investors on edge as, again, markets sink back into correction territory today. Almost everyone feeling it in their 401ks and IRAs if you have dared to look. But our next guest is Empower Retirement CEO Ed Murphy, says his customers are showing remarkable resiliency. Empower handles retirement accounts for more than 9 million Americans. Ed, welcome. So when you say resiliency, I assume you mean in there.
They're hanging in there.
They're not acting rationally.
Irrationally. No, we don't see that. What we see is inquiries up. So our call volumes are up 15 to 20%. Activity on the web using mobile devices is up. But there's no capitulation. You know, people are calling to get account balance information. They're calling for reassurance. But we're not seeing really an increase in trading activity or flight to quality.
Are most people in their 401ks sufficiently diversified, or are they overconcentrated?
I would say they're sufficiently diversified, Tyler, in the sense that disproportionate amount of the flows and the investments are in target date funds, and that's a multi-asset structure. And so they've got exposure to fixed income, they have exposure to equity. And so from that standpoint, you know, we're seeing people well diversified.
Are the target date funds working as they theoretically are intended to?
I think to some degree, yes. But
that's a fairly faint praise there.
Well,
It's okay because 100% of my money's in it. So.
Well, no, let me get
honest.
Here's my perspective on that. You and I can both be age 40. You're willing to take risk. I'm not willing to take a lot of risk. You're healthy. I have cancer. So longevity is a factor. And we get placed into the same target date fund. So I think where the market's going is to more of a personalized type structure that takes into consideration some of these critical inputs. And that's what we're working on, frankly, with several asset management firms.
And obviously not all target date funds are created equal. There can be 40-year-old target date fund for 40-year-olds that are more risky than others. So you got to know what's in your fund, as you always do.
That's exactly right.
Yeah.
The other thing I would say is increasingly what we're hearing from the nearly 10 million Americans that we work with is they're looking for advice. And you know, whether that advice is embedded in a product or whether it's delivered by a human being, they want to turn it over on a discretionary basis.
Not to belabor the point on target date funds, but it's always stuck in my head that there is an implicit promise in those funds that if I'm a 40-year-old and I put my money into one of these target date funds, the amount is going to sufficient to support me in retirement is going to be there.
Well,
period.
Certain things are explicit too, right? In terms of there's some protection on the downside, there certainly is some upside. Yes. But I think the question ultimately is, have these folks been in a bull market for so long that you talked about that lack of capitulation? Does that worry you?
And you've got 12 seconds.
Yeah.
It does worry me, but I think that the industry's done a really good job in reassuring investors that this is long-term money and that you shouldn't react emotionally to the swings in the market, that it's really, for the most part, it is long-term money, and you get the benefit of dollar cost averaging and reinvesting.
And we have to leave it there. Ed Murphy of Empower, thank you very much.
Thanks everyone for watching Power Lunch today.
Closing bell, watch the next hour. We'll be here tomorrow.
Welcome to Closing Bell, everyone. I'm Sarah Eisen on the floor of the New York Stock Exchange. Another major sell-off on Wall Street. Volatility continues to shake this market. I'm here at the post of Royal Caribbean. Stock is down 16%, tracking for its worst day since 2009. Also, you can see Carnival and Norwegian down double digits. Those three stocks, the cruise lines, the worst performers in the S&P 500, 59 minutes left of trade.
And I'm Wilfred Frost. Good afternoon to you. Let's have a look at what is driving the action. The spread of the coronavirus continues to dominate headlines, with travel and aerospace stocks particularly suffering. Bonds surging, yields making new record lows today as the 10-year fell below 0.9%. And OPEC backed its biggest output cut since the financial crisis, dependent on Russia's approval. Energy, though, still one of the worst performing sectors today. Coming up in the next few minutes, we'll discuss what this all means for the retail sector with NRF President Matt Shea, and we'll dive into tech valuations with legendary tech investor Alan Patricof. That's all to come. Joining us for the full first hour of the show, CNBC contributor Stephanie Link, along with CNBC senior markets commentator Mike Santoli, who's here as well. Mike, quick first question to you. We're down 1,000 again as we approach the close. Interesting to me, though, is the fact that week to date, only 3 sectors are in the red. And again, a big sell-off today, but off the back of a strong Monday and a strong Wednesday.
Week to date, the S&P 500 is up a couple percent.
Yep.
So the overall market is up. And fascinatingly, even though we've had these massive daily moves, today was basically just within yesterday's range. Yesterday was within the prior day's range. I'm not saying that's going to continue and we're going to continue narrowing from here and all of a sudden the storm has passed, but it really is the market fighting to figure out the same set, wide spectrum of outcomes. Today, what's really notable, though, is the cyclical areas of the market getting brutally hit. And so we're really essentially pricing in a steeper slowdown today. It's not really just, those big tech stocks that were up a lot. It's pretty much the cyclicals today.
What do you do on a day like today?
Stay calm. I mean, the day-to-day action it's staggering to me, guys. And I think much of it is algo driven, quite frankly, because I don't know very many people.
4% moves, 3% moves.
Yeah, and I think 1%, you break 1% in the 10-year and all of a sudden another algo's hit, right? So I'm not saying that no one's doing anything, but a lot of people that I talk to aren't doing very much, and whatever they're doing is kind of slow picking away, and that's kind of what I'm doing, because I don't think we're out of the woods. The volatility is going to continue because we do have so much uncertainty, not just about corona, and oh, by the way, we get more tests next week. There's going to be more cases and people are going to be nervous, but what the implication is to earnings, to the economy, we can't model out that. And that is something that as an investor is very challenging. So what I'm looking at copper, which actually has stabilized. I'm looking at the 10-year, I'm looking at gold. When those things kind of start to act better, I'm actually going to feel a little bit better. In the meantime, what I said last week is I'm kind of quality upping my portfolio.
Like what?
I bought United last week. I bought, because it went, we talked about it, 300 to 250, Nike 104 down to 85. I bought AbbVie yesterday with a 5.1% dividend yield. I bought Zoetis, which hasn't come down at all, and I'm hoping it's going to come down because it's the best animal health care company out there. And I bought some Wells Fargo at a 5% dividend yield, which is staggering to me. So I'm looking at opportunities. These are all going to go down if the market goes down, but I'm hoping that they go down less, given that they've already pulled back.
United, you said United.
United Health.
United Health. Okay.
No,
Not United Airlines.
Oh, God, no.
Well,
I'm not touching an airline. Not right now.
All right, we'll talk about that later. We are all over this massive sell-off on Wall Street. Full team coverage of the final hour of trade for you. Bob Bassani, biggest movers on the floor. Rick Santelli on those drop in yields. Mike has the market dashboard. Meg Terrell monitoring latest developments with the coronavirus. And Phil LeBeau is in Washington as airline executives gather for a summit. Bob, first to you, though, on the floor.
You know, there's a lot of debate, Sarah, about whether this is a demand issue with parts issues around the world or supply, just reduced consumer demand out there overall. And I think we've answered that thing. This is a supply and a demand issue. Demand is clearly decreasing on the consumer side. If you take a look here at Live Nation, not just cruise lines, but look at Live Nation here, down 8%. This is a 2-year low for Live Nation. Madison Square Garden also has been down rather dramatically. Got concerns here about sporting events and concerts being canceled. Look just above that. I'm going to show you that the banks are having the same issue, and really for the same reasons. This is Comerica, down 7.5%. This is a 4-year low for Comerica. Other banks like M&T, big regional banks, 4-year low. U.S. Bancorp, new low. Wells Fargo. And I know it's very easy to say, oh, it's because of the lower yields. Yes, but there's a lot more here going on with the banks. They're dealing with the potential for lower loan demand. They're also dealing with the potential for more loan defaults. These are very important components. So this game is not just about yield. And I think, guys, we've settled on the supply versus demand story. It's definitely both going on here. Back to you.
Bob, absolutely. We're going to talk more about the banks a little later in the hour. Meantime, the 10-year falling to a record low. Let's get to Rick Santelli at the CME. Hey, Rick.
Hi, Wilf. You know, twos right now are only down 10 basis points. 10s are down 12. All maturities are finding a little bit of lift. Look at a week to date of 10s. Notice that Tuesday's extreme of 0.9 was violated. We've been talking about that. But here's something interesting. A week to date of 30s, the 150 on Tuesday has not been violated. The low has been 153 ever since. Something to pay attention to with regard to, are we all alone in this dynamic of flight to safety, which might not be safe? No. Look at a 20-year chart of gilts at 33 basis points. You're not going to find a lower one. It's historic. Let's look to Canada, our neighbors to the north. Their 10's at 85 basis points. There's a 20-year chart chart, you're never going to find another one. The point is that the dynamic isn't so discriminating as to be telling us about our economy. It's telling us about where people are running from and where they're running to. Sarah, back to you.
Quick question, Rick. I mean, the plunging bond yields, at what point do you think that can act as stimulus for the economy? We see mortgage rates, for instance, now plumbing record lows. But where else should we be looking for an impact, if at all?
Well, I think everything that is out of control has a positive side to it when things settle down a bit, whether it's lower yields, although, unfortunately, the big boys of the world get to take advantage of them, the average person, through mortgages maybe, even maybe car loans. But they correlate, but there's a big add-on. There's big haircuts to most of that. I think energy is the other extreme. Everybody's looking at the sector, but the average middle-class person is going to be able to fill up for less, and maybe if they're not so panicked about going outside, they'll drive more and use more energy.
All right, Rick, thanks. Let's go back to Mike Santoli, today's market dashboards. Mike, what have you got today?
Yeah, Sarah, obviously investors trying to navigate these big swells and breakers in the market, really these kind of violent waves. Take a look at this chart. Goes back to June of last year. This captures, I think, a lot of the relevant areas that we've kind of gone through right now. So this big vertical, near vertical drop, and then this very jagged attempt to put in some kind of a very short-term low. It kind of brought us back to these areas, right? The lows of the summer, when the low 2800s on Friday we hit there. So we've been kind of trying to see if this is going to be a cushion for the market. Back then it was only like a 6 or 7% pullback. The pullback wasn't a big deal, but we were in panic mode to some degree about a recession coming. So we've unwound that entire lift that priced in some kind of an economic reacceleration. Look at this chart though of calendar year 2011. The day-to-day action is very similar. A lot of the stats that are generated in the trading dynamics are taking you back to this period in August and October of 2011. We had the potential of U.S. debt default, sovereign debt crisis in Europe. So there, vertical move, just as I showed you on the other chart. And then this very jagged attempt, right? Violent rallies, massive sell-offs, in successive days. We eventually did kind of retest and go down through the August lows in October, then finally had a recovery into 2012. I will say valuations back then were much friendlier. It was, we actually cracked below 11 times forward earnings on the S&P for a while. Bond yields much higher. So there was a little more play in terms of the buffer for valuation, but also I think less confidence in the bull market in general. So I do think that's decent context.
I mean, Mike, in terms of that comparison, though, 2011, we had way bigger questions being asked about the future outlook than we do now, or so far than we do now.
Yes. Well, you would think, right? Is the United States going to default on its debt?
Well, much
the
more.
Eurozone going to hold together?
The Eurozone country's going to default.
Things. Absolutely.
Yeah, and in that sense, what we've seen over the last couple of weeks is aggressively more pronounced than anything we've seen before relative to what's on the cards.
Well, and maybe the valuation levels we're at right now explains that, but also the inability to really handicap the range of outcomes, I do think is significant at the moment. And again, I keep pointing to the 9/11/2001 scenario as well, where arguably you also had much more existential issues on the table.
I mean, earnings are uncertain, but the multiple's already contracted two multiple points from its high, from the beginning, from the all-time high.
What do you think Wall Street wants to see? Do you think they want to see the tests in this country ramp up so we get a better feel for the numbers we're looking at?
Yeah.
And that feels like a key uncertainty right now.
It is a key uncertainty, and I think if we get it starting next week, is that the peak of bad? And once we kind of get familiar and comfortable knowing that it is the peak of bad coronavirus, then we can actually start to try to model. Because right now there's no way. That's why I'm buying on yield.
The other thing people just don't know, and I don't know that the health experts have a good answer at this point, which is how long is this going to last?
Right.
Does it go away in the summer? How long is this with us? Because Ed is another huge uncertainty where it would be impossible to model earnings and economic shocks.
Right.
Well, the other thought is that the formula for making sure we limit the spread is to curtail lots of economic activity, and for everybody to essentially
downturn?
Listen, I saw the 70s blip. I saw the 90s. There's always something that dramatically happens, and I think we're going through. This is a serious. There's no question about it. But I think that if you hold on to good fundamental stocks, I certainly haven't sold any stock I own in the last several weeks.
So what are you looking for to get more confident? I understand you want to buy, but you're not right now. So what will it take for you to buy?
I think we need to see.
Hey, what's up, guys? I'm back here, just about to do a market wrap up for everybody. Kind of look at all the trades and look at everything. SPY's right now down about 3.5%. So
I just think general economics.
Let's pause these guys over here and kind of go over some things. All right, so here is what the market pretty much did today. Let's zoom out here so that we can get a outside look in. So we've got quite a bit of volume here at the end. We've got another crazy day of downward movement after a lot of upward movement. Guys, back in 2008 was the last time that the Feds cut interest rates just randomly by 0.5%. So that in coronavirus is what it looks like. Is basically quite a bit of volume here at the end. We've got another crazy day. Sorry about that, guys. I had this on the other TV as well. But yeah, coronavirus and basically what are the central banks going to do to basically go through all of this down economic, like the global economy is going to slow tremendously because of the coronavirus. Even if it doesn't kill like as many people as the flu or whatever the reports are, everyone's getting freaked out about it, and fear and great greed drive these markets. So you can see over here my little quote watch list that I like to always look at. There's a lot of red there, just a lot of red everywhere. So the two things that you actually do have up are the VIX, which is almost at 30. One of my dad's favorite rules is buy stocks whenever the VIX goes over 30. So it might be a good time to see about getting some calls and some plays maybe related to the coronavirus. Kroger and Walmart are obviously going to be having a really good quarter as their shelves are completely empty, but they're doing a good job, I guess, right now of restocking those shelves. So I think that they might actually earn quite a bit more money than they think, and hopefully the summer season kind of kills out that flu up here and earnings continue to rise, and this kind of gets the flu kind of gets killed out by the summer weather here at least, and the markets continue on. But you can see right here the TLT, that's what I've been actually talking about with a couple of people these last few days. I think obviously when the Fed cuts rates here, let's go look at the chart. This is the 20-year, yeah, the 20-year Treasury Index Fund basically. And when we zoom out, it's pretty crazy, because what happens is every time any central bank or anybody goes ahead and starts to do more monetary policy and easing, they're basically printing more funds and buying their own bonds, and to sterilize the way they do that. And so that's going to make bonds rise and their interest rates continue to fall. If you guys all need to refinance your mortgage, it's going to be even cheaper now. At least it should be, now that the rates are going to be cut. So it could, that's what the Fed is doing basically to stem economic growth for the moment. So, but there are going to be plays on the downside because of this coronavirus. Some of the other plays, so that's a long play right there. Let's take a look at this one here. Starbucks. This is one of the short plays that I would you know, if you have the availability to get some puts on this. I mean, this Starbucks is talking about how nobody is in Starbucks right now, and they are, you know, nobody wants to go buy coffee because everyone's worried about getting the coronavirus. Another play on the downside here, while the market is struggling to understand what coronavirus is Uber. Uber, nobody's going to want to ride in anybody's car, anybody else's car, because they're going to be afraid of sharing germs, just like taxis and airline companies like American Airlines. Yeah, obviously they're going to just continue to tank. I wouldn't be surprised if they go down as far as like $5. Or I'm sorry, that's Alcoa. Where is American Alcoa as well? So American Airlines here. Where is it? American Airlines, there they are. I missed the L. Well, they're tanking even harder, so they're probably going to continue to do that and continue to go down as you would think about these, you know, this coronavirus as just basically spreading to all of the other parts of the world, and they're doing it via airplane. So these are just kind of like, you know, test tubes of coronavirus in all in the air, traveling around the world, as nobody has been tested yet to the capacity that needs to be testing. What you have to do is you have to basically get to a point where you're finding so many negative tests that it's like ridiculous, because that means you're containing the virus. When you don't have enough tests to go out there and when you don't have enough tests to go out there and test everybody, and you know, you only have 300 tests or whatever for an entire town, you know, it's not going to cut it. We need to be testing everybody to figure it out where everybody has it and who has it right away, so that they can be self-quarantined themselves and taken care of. So yeah, guys, the market here is just continuing to pull back here. Let's go back to the SPY over here, 301.24. So guys, I talked about 2008, back when the Feds lowered interest rates, and they did that obviously because of the economic concerns that the housing market and Lehman Brothers actually when they crashed. So they definitely have a hey buddy, hold on real quick, okay? I'm talking to the people about their stocks and the market. So when we have the Lehman Brothers crashing and the Feds try to step in, you saw a lot of this buying. The same thing happened in the 1929 crash. Like, a lot of big players came in and tried to step in and get stocks at a discount, but and everything was good the next day, and then all of a sudden it crashed, and in 2008 you got these wicked volatile days as well. When you see 1,000-point swings back and forth, I mean, that's just a lot of uncertainty, which is why the VIX here is rising as well. Now, I always say to be careful, you know, with you guys playing any sort of like leveraged ETFs or anything like that, because what those basically are is they're short contracts in the future, and they have time value attached to them, and that makes them depreciate unnaturally so, and that's just how that works here. Let me just pop in here and see if there was anybody paying attention at all. So, all right, well, the VIX is rising. I think that the market's going to continue to do what it's going to do with the coronavirus plays. A lot of people are getting contaminated. You see, like, U.S. Bank is down here, pretty good. Let's see. Guys, price and volume basically drives everything. News is just like it's something that happens like after everybody knows about it, and so you always gotta trust the volume and trust the prices, because as soon as the first person finds out, like, there's trading going on about it. That's just how fast our markets are nowadays. You got a lot of down here today, guys, and it is just red. Now we got gold and silver up as well. Those are going to be some other plays that you want to take a look at here. GLD, that looks pretty nice there with that chart. So that is how I'm going to play it here for overnight, guys. I'm going to stop the stream here and end it at least on the volume side here. So we'll catch y'all later.
starting to say they're in the zone of that they're over discounting.
That thesis is being drawn not from economic data, which continues to look pretty good. I mean, claims were not a problem today, jobless claims, but the anecdotal look, if it's going to hit cruise lines and airlines and business travel and events and concerts and malls, and it starts to pile up in terms of the damage that this is going to do into the economy.
And that's why I go back to how comfortable are you with the consumer? How much do they actually pare back? Because we know businesses have already pared back. They haven't even contributed in CapEx for years, right? So it's going to be the consumer and how can they hang in. Back on the banks, though, for a second, I'm waiting to see the alts actually come in, like a Blackstone. Apollo's down 11. Blackstone's up on the year. Those benefit from low interest rates, and so those are the ones that actually you may want to be picking at, along with some of these other beaten down banks.
Just want to quickly end with a 5-year chart of Bank of America, because this is a sort of bear case if we're being a bit crude on the fact, which is go back to 2016 when people were thinking, oh, we're in a zero rate environment forever before rates started to rise, and we have a long way to go to get back down to that. So if you're just being very simple, very crude, that investors are thinking, oh, rates are going to zero, banks aren't going to be able to make money, whether it really affects their EPS or not, if that's how people are thinking, there's a long way to go. But clearly, they are making a lot of money and the dividends are pretty strong.
They are, but their yield is 2.7%, as we talked about. Some of the others are a lot higher, so I'm not sure people are going to gravitate. Plus, you know this, that they are the most exposed on the yield curve. So, I mean, I think there's going to be a point where you really do want to back up the truck, but maybe just wait a bit on that one.
One stock that's actually bucking the trend today is Kroger. That stock hitting a 3-year high after reporting a beat on earnings, also a beat on sales for the quarter. Kroger reiterating their guidance despite the coronavirus outbreak, citing Kroger's limited supply chain exposure to China and saying it's too early to measure how it will affect their business overall. Basically, they kept guidance without the big boost that the Wall Street is expecting as a result of corona. Here's what the CFO said on the conference call. In the last few days, customers are spending more on water and hand sanitizer, soap and paper, and boxed dinners. The company also has rationed the number of certain sanitation and flu products from online orders, guys, limiting to them to 5 per person. So clearly the view here is that names like Kroger and Costco is going to report after the bell are going to get a tick up in business, though executives were key to play it down on the call because, they want to show they're in the middle of a nice turnaround and they're starting to show results. The Restock Kroger program, sort of similar to what we heard from Campbell, they don't know how long this is going to last.
I know, but at least they had better comps, better ex-fuel gross margins were the real highlight, to your point, and I do like the turnaround story there, but my heart is in Costco. It's way more expensive and it worries me more on valuation, but I got to think they're a huge beneficiary as well.
And in general, the market's not going to pay up for front-loading purchases, right? You're not using more paper goods because you bought a lot today.
Although Costco was up 10%.
No, that's what I'm saying. So the market actually usually is not going to pay up for valuation, but it's a harbor in this kind of market.
But also you could argue that if you go out just to hoard toilet paper, you're also buying groceries and everything else in the store.
And you're not going out to eat as much.
And that's not that's a recurring purchase. Food goes bad.
Meantime, the energy sector getting hit hard, down more than 19% in just the last month. Our own Becky Quick sat down with Exxon CEO Darren Woods moments ago, and they discussed the coronavirus's impact on oil.
We've got to take a very long-term view, and the investment cycles that we make are anywhere from 5 to 10 years, and so our strategy in laying out our plans is to make investments that are robust to these down cycles and so that you can ride through them. We've got a key competitive advantage with the balance sheet, and so we build these advantage investments that are robust to the down cycles, and then we use our balance sheet to kind of ride through these turbulent times. The economy, I think, over the medium to long term is going to continue to grow. So the demand for energy, which is closely linked to economic growth, is going to continue to grow.
Mike, to the point about the two worst performing sectors of late, banks and energy. Banks aren't anywhere near their 2016 lows. Energy very much is.
It very much is, even though, crude oil prices are not, and it's been the pattern all along. It seems as if almost anything that comes along is an incremental reason to lighten up on energy. And it's difficult to see in this environment when so much of the world is essentially operating on a slow speed or stall. At this point, the commodities keep piling up. It's just difficult to work your way through that.
in terms of sentiment.
Oil down again despite the OPEC action. Mike, you've been looking into the market internals here. 2 minutes to go, down 1,000 points. On
Yeah, another lopsided negative day. If you look at up-down volume on the New York Stock Exchange, it's another 90% down day, pretty much, give or take. So that's multiple ones we've had recently, very much like that 2011 period. Utilities against industrials. Same story we've been talking about. Of course, transport's a big chunk of the industrials. That's showing a wide divergence on the day. The volatility index has popped back above 40. That's probably an uncomfortable spot for it to be in, even though the market's above its lows. That's pretty much at the closing highs or so. So that still shows you a bit of a hazardous market out there.
All right, we are just under 2 minutes to go. Let's head uptown to Bertha Coombs at the NASDAQ. Bertha.
Yeah, you know, Sarah, we are seeing here in the NASDAQ falling back into correction, negative for the year, but for the week still up. And that's because a lot of the big caps are still holding onto their gains over at least the two sections that have been up so far. Zoom is seeing a big reversal here during the day. The stock disappointing in terms of the company's outlook for more business as a result of coronavirus. Nonetheless, they are higher. And take a look, a lot of these video chat companies are moving higher this week as well. Over to you guys.
Bertha, thanks so much for that. Here on the floor of the stock exchange as we approach close. 1 minute left. We are down 3.3% on the S&P 500. That is well off the lows, which was down more than 4%. Regardless, another massive day of selling here on Wall Street. Yields have played a big part. There's a snapshot. 2-week chart of the 10-year. We've gone from 1.4 to below 0.9, but the yield itself is off the lows, and that has helped stocks as we approach the close. Here's the worst sectors: banks, energy, as we've just been discussing, continuing to suffer. The defensives like utilities, staples, and healthcare, the best performing. Bob Pisani joins me here. We're going to flip to an intraday chart of the Dow as we discussed. But Bob, the things.
Here's the story. We've had a lot of debate about whether this is a V, a U, or an L-shaped recovery. Obviously, the market's telling us it's not going to be a V-shaped recovery. Think of the demand destruction. Think of restaurants. You're not going to eat twice as much if you go back to your favorite restaurant 3 months from now. Some stuff isn't going to come back, Will.
Well, some of us will, but I take your point. We are down 3.5%, 967 points on the Dow. A little bit off the lows, but nonetheless a massive absolute move to the downside once again. Sarah, back to you.
Nice,
Another big sell-off here on Wall Street. Welcome, everyone, to Closing Bell. I'm Sarah Eisen. Wilfred will be rejoining me from the floor in just a moment. I'm here with Mike Santoli, as always, CNBC Senior Markets Commentator. Take a look at how we finished up the day. Another massive move lower for the Dow, down 972 points, 3.6%. For the S&P 500, 3.4%. It was broad. Every single sector finished in the red. Groups like financials got crushed, down 5%. You had the real cyclical trades, those that are tied to the fate of the economy. They did the worst today: financials, industrials, and energy. Take a look at the NASDAQ, faring a little bit better than the other averages, but still, big sell-off there, down 3.1%. The Russell 2000 index of small caps also getting swept in with all of the selling. Bond yields hitting new record lows. There's the Russell down 3.4%. This comes after a day where the Dow jumped 4%. Crazy action, extraordinary moves. Transports falling to a new 52-week low today as airline executives meet in Washington to talk about the coronavirus. And coming up, we will talk to former Continental Airlines CEO Gordon Bethune on the state of the sector. Joining us to talk about the market today and what to do next, Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. Michelle Meyer is here, Head of U.S. Economics at Bank of America Merrill Lynch. Still with us is Stephanie Link, CNBC contributor. The first to you, Mike, on another just stunning move in stocks.
Yeah, every day this week, the S&P has moved at least 2.8%. It's alternated up versus down, mostly 3 and 4% moves. And as extraordinary as that is, it's not necessarily unusual after the shock and the fastest 12% drop from a record high we've ever had. It tends to be the way you go with these kind of low visibility, high emotion kind of spring-loaded markets. I was just observed that we've tried to create this little bit of a lower end of a trading range over the last 5 days. So in the zone of S&P 3000 or a little bit below that, if you want to go on the assumption that that somehow is where you've had some buyers try some things, that's fine. It's not decisive. As I said, we really can't kind of say until we've lived with this threat for a while and gotten a little more time in terms of metabolizing the threat of economic impact of the virus, it's difficult to have any confidence. But in terms of the market tactics and dynamics, this is what you get in the crucible of a correction.
Lizanne, are we in screaming buy or screaming sell territory yet?
Oh, I don't think so. I don't think either technically or from a sentiment perspective, leaving aside the fact that we have no idea what the next month or two or however long it is going to result in terms of the impact of the virus on the economy, what the containment measures are going to be. You know, companies are withdrawing earnings estimates. They're not just guiding down. So leaving all those uncertainties aside, you know, it is a typical pattern if you are sort of finding a bottom, and I don't know whether we are, to have some retests, to see relatively weak breath on attempts at rallies, and then ultimately you sort of retest and you have a much stronger breath move on the upside. We obviously haven't seen that yet. I don't think we've seen a significant enough reversal in what was incredibly frothy sentiment that registered at the highs in January. So I think leaving all the actual factors that are driving this aside and just looking at your standard sort of technicals and sentiment, even there it doesn't quite look like we're there yet.
So add it all up, Lizanne, and what are you guys at Schwab actually telling your clients to do right now?
Well, we haven't made any recommendation changes for the last 3 years. We've been, from a tactical perspective, what we call neutral to equities, which just means don't go above your normal long-term allocation to equities, and that's going to vary by investor in terms of how they're strategically positioned. We've taken a spread around that of overweight large caps, underweight small caps, and on relative basis, I think that's still the way to go here. I think the profit fundamentals, the balance sheets, the percentage of zombie companies, I think is heavily still biased toward the higher quality, larger cap companies. But what we've really been pounding the table since early 2018 is in this more volatile environment, be more cognizant of, number one, diversification across and within asset classes, and more systematic and frequent rebalancing in order to take advantage of these swings and kind of basically stay on the right side of the trade, so to speak, trimming on the moves down to the extent it's been significant, or trimming on the way up and adding on the way down. It's kind of tried and true, typical disciplines that we always espouse, maybe even more important in this environment.
Michelle, as a head U.S. economist, how do you try and gauge the impact on the U.S. economy? And roughly speaking, how much lower do you think it would have been than it otherwise would have been?
Yeah, so obviously that's the big question, and every day it seems like we're learning a little bit more about how this might feed into the broader economy. So you first think about the direct hit, which is through a supply shock, and you can kind of gauge that. You can look at how supply chains are disrupted. You can get a sense of how production may or may not return, and you can understand a little bit about the business reaction. So that's understandable. You can pencil in the inventory drawdown. What I think gets a lot harder is around the consumer reaction, whether or not behavior is changing. And that can happen swiftly, and it could also happen driven by what's happening in the market. So if consumers are worried about their health, they're worried about their finances because of what's happening in the stock market, they start to become a lot more cautionary, they change their behavior, and you start to get an adverse feedback loop develop between what consumers are doing, what markets are doing. Is that what you expect? So no, I mean, I think we're seeing it a little bit. I think it's inevitable, but no, we don't expect to see a real painful one that brings down the global economy. But I think at this point, there's just scenarios that we can play with, and we have to think about all these different linkages and be willing to adjust forecasts as we see the data come in, as we see that high frequency data, which are going to be surveys and sentiment shifts.
Stephanie, where do you stand on whether the market's selling off because of fears of a recession or just wild swings in sentiment that move stocks, even if we don't think GDP is going to fall that much?
Oh, I definitely think there's fears of a recession because we can't model anything, as we've talked about last hour. Here's the thing, though, guys. The Dow's only down 8% on the year. The S&P's down 7.5%, and the NASDAQ is down 2.6%. It feels so much worse, though, right? Because of these major swings. And I think we talked about earlier, it's really more algorithmic related, and it's hard to get caught up in all of that. So that's why I have said many times, you don't want to go all in, but I do think there are stocks and sectors that are down way more than the averages, that have gotten punished beyond belief, that you have to take a stand, especially if they are blue chip, number one in their industry, and you're getting them on sale.
So just remind us what exactly you've been doing with that advice today.
So I have been picking, and we talked about some of the names that I've been buying. AbbVie was yesterday. It's yielding a 5.1% dividend yield. Zoetis is a name name that I've never owned, that I totally missed, and it's only down about 7% on the from its high. So it's still expensive. That's one that I absolutely want to buy. It is the #1 animal health company in the industry, phenomenal management team. I am looking at some of the financials. The one area that I'm not really aggressive on, I'm not really aggressive on technology because those stocks are still up on the year. Some are up double digits. I know you want to own some growth, but I think you want to have those companies come down, particularly the FANG stocks.
Let's dive into the move in yields, which, similar to stocks, was large. Rick Santelli's got an update for us from the CME. Hey, Rick.
Hi, Wilf. You know, if you look at charts that start on Tuesday, here's what you want to watch for. There's the 10-year. 89 low to 90. We took it down to 89 today. It's a tick or two above that. If we violate that with the time remaining in the cash markets, that wouldn't be good. Unlike 10s, 30s have left their 150 spike on Tuesday unchallenged, and there's a bit of a cushion at 154. That's a good thing. Curve has flattened a bit today. And if we look at the notion, all our guests are so nervous about corporates, and I get it. But here's 10-year spreads by Barclays of corporate, investment grade, and high yield. And believe me, things could get worse, and maybe they will. But at this point in time, I'm impressed, very well behaved, considering they're measured against Treasury yields where the floors dropped out. Sarah, back to you.
All right, that's a positive sign, Rick. Thank you, Michelle. I mean, you're an economist that works on a trading floor, right? So what's it been like on the rate stats this week as we've seen these new record lows after record lows in treasuries?
I mean, you can imagine the sentiment. It's a little bit of gasping. It's a little bit of where's the bottom? When do we get to zero? So you're starting to hear that type of conversation, which is how low can we go? And obviously the Fed cutting in emergency fashion by 50 basis points, signaling that there's more to come, market requesting that more should come, and the Fed not looking to disappoint markets. I think there's a view that we could see further capitulation, further drop in yields at some point. But people are also trying to think about what comes next, right? So is this an L shape or is it a U shape? You know, is there another side? And if there is, at what point does that become an attractive entry as well?
What's your base case?
So we think there is another side, right? It's probably a U. It's probably maybe it's a deep U. It might feel a lot worse before it gets better, presumably. But at the end of the day, it does seem more to be a temporary shock. The fundamentals of the economy were quite sound prior to the virus really hitting in a significant way to the global economy. So we are in the view that we will get to the other side of it. The question is when, and it might take some time, unfortunately.
So if you're expecting a U, do you not think the Fed cuts again?
No, I think they cut. I think
that's already priced into where yields
I think that's largely priced in. So I think they cut another 25 basis points at the upcoming meeting, followed by another 25 basis points in April. So that's 100 basis points of cuts. And then the view is maybe they've done what they need to do to stem panic, and you can start talking about more targeted fiscal actions, maybe some sort of joint work between the Fed and Treasury. And in a way, the Fed, I think, is trying to buy some time and hoping they can stem the panic.
What does that do to stocks if you get 100 basis points?
100 basis
cuts?
points.
That's quadruple.
I think whatever it would do to stocks, what it would do before the cut came, right? So I do think it's the conditions under which you're getting that cut. And if it may, who knows, maybe 25 is a disappointment if that's all we get in a couple of weeks. I do think you have this very profound upside down situation where the federal funds rate for overnight money is above 1%, and almost no other yields in the world of any maturity are above 1%. So that's a part of what I think the market is trying to assimilate. What does that mean? Does it mean the Fed is implicitly too tight? I don't know.
Michelle, do we get to 39 on a PMI like China?
I don't think we do. I mean, for China, it was so dramatic. The economy shut down. Their factories shut down. It was an extreme set of quarantines. And so no, I don't think we get there here in the U.S. The other thing we need to consider in the U.S. is that we are somewhat a function of what's happening in China. The fact that factories are starting to be a bit more, they're coming back, they're up and running, they're moving again. Product could slowly filter into the U.S. So I don't think the shock is as acute to the manufacturing industry in the U.S. as it was to China. But you should imagine, and we are forecasting we fall below 50 in those ISM surveys.
Lizanne, we've talked a lot today and the last couple of days about how energy and banks have suffered the most in this sell-off for understandable reasons. But have they got cheap enough to buy those sectors?
Well, we're making some adjustments to our sector recommendations right now. For lack of a better word, that means I'm kind of quarantined from talking about sectors. So I think that's clearly one of the reasons why small caps continue to underperform, because there is a much heavier bias within small caps to sectors like that, to financials and energy. So I think that ties into some of the factor-based performance numbers that you're seeing, whether it's growth versus value and large versus small.
All right, Lizanne, thank you. Another massive sell-off today on Wall Street. Dow closing down 969 points. Let's get back to Bob Pisani on the floor of the NYSE. Bob.
We are grappling with the extent of demand destruction we're going to see, but you see this in the travel and leisure industry. Look at Carnival Cruise Lines, 11-year low here. Some of these cruises are not going to be rebooked, even if it comes back in a few months. Live Nation, people aren't going to go to some of these concerts just because they're canceled now. Doesn't mean they're going to be rebooked again down the road. Look at the restaurant business. Darden, they own Capital Grille Steakhouse, high-end, down 25% in the last month. Some people aren't going to go back to their restaurant for 3 months. If they go back, they're not going to eat twice as much. There you see Darden, big decline there. Banks, same situation, and it's not just yields. New lows on Comerica, M&T Bank. We see lower loan growth as well, potentially, and possibly higher defaults on the loans out there. So multiple things going on. So that's why we're getting this chaos. Is it a V-shaped recovery, an L-shaped recovery, a U-shaped? It's not going to be V-shaped, folks. U-shaped is the best we can hope for. And remember, we're taking this hit on the demand side and the supply line side. That argument is all out the window. It is both of those. Back to you.
Bob, thanks very much. Or a slow you, would you, or a wide you?
A deep
you?
yeah.
There we go. Well, Michelle, one question I do have in terms of the impact on the economy. If we see much worse than expected in China and Italy and the Eurozone, but not a domestic shock here, will that drag down US GDP from the global effect, or are we quite insulated?
Yeah, no, we're not. We learned from the trade war, we learned from the European debt crisis, we've learned that we are a global economy linked through trade, but also linked through credit creation, linked through the financial system. So even if it doesn't turn out to be a domestic shock or an acute domestic shock, we will see slow, and we're already seeing the hit to production here in the U.S. But when it becomes a lot more problematic if it does change behavior here on the ground, if businesses change how they invest in labor or their willingness to hire right now in this environment, or if consumers start to hunker down and save more and buy necessary items and not discretionary, you do see a hit to the economy, certainly.
So I feel like, Mike, we're talking a lot about the worst case scenario, the sort of the gloomier outlook on what could happen. On the plus side, Rick showed us a credit chart. I mean, we're not seeing sort of liquidity problems. I mean, talk about all the things that people are watching as we have this recession debate, or how sharp this is going to be.
Right, it's not real-time stress in the system. It's anticipatory of what might pop up in terms of cash flows being pinched and things like that. So that's why the market's trying to administer the punishment in the appropriate areas as opposed to across the board. I also think that, you mentioned we're talking about a downside of what kind of recovery it is. We don't really know what the slope of the down is, or if it's just going to be a pause. I do think there's a scenario out there, you will hear people say it, that this perhaps is a fairly contained stretch of modified corporate and consumer behavior where it doesn't necessarily last very long, and then we find ourselves on the other side of it with, who knows, a full percentage point of Fed rate cuts. Companies still didn't really have that much pain, and the stock market down 12, 15%, whatever, and then what happens from there? You actually have kind of a pretty dramatic snapback, presumably.
By the way, do you read anything into the fact that we didn't close at the lows of the day? I mean, we've been closing at the lows and the highs of the session. Closing down 959 feels painful, but actually we're down more than 1,000.
Yeah, that's why I said, this one little level of the S&P around 3,000, folks came in, didn't let the index go down too far below that for long on any of the recent down days. Is that significant? It could be. I don't want to scrutinize every twist and turn of these days.
That's why we have you.
I know, but you have to widen it out.
There you.
When the market's decided it's moving 3% a day, then it doesn't really stand up to that kind of line-by-line reading.
Lizanne, Michelle, and Stephanie, thank you all so much for joining us. We will leave it there.
Jeffrey Gundlach was on CNBC earlier today and predicted a major hit to economic growth. Listen.
Obviously, the airlines are in free fall for good reason, and small business activity is going to contract. I think it's foolhardy to think anything other than this is going to take a major hit to short-term economic growth. I mean, maybe grocery store sales will go up on a short-term spike, but all other kind of social activity is grinding to a standstill.
Jeffrey's best known for some of his calls on bonds. And so, I mean, clearly he's seen the action in the bond market, and bond experts tend to often be gloomy, but I think what he's saying is a lot of what's being factored into the market right now, especially with the selling today, sharp selling in industrials and bank stocks and consumer stocks.
And his point about the airlines, goes to what Bob was saying. That is not coming back anytime. You're not going to take an unneeded flight 3 months down the line. Though, to what we were just discussing with Mike, their balance sheets, sure, maybe Americans got more leverage than Delta or whatever it might be, but we're not talking about companies that are about to go bust and fail to meet a cash call. And yet they have fallen aggressively. The cruise ships have fallen 50%.
The cruise ships, I mean, I do think there's a little bit of a question as to how long the resistance to cruising lasts. They're really not the most wonderful, highly valued businesses in normal times necessarily. So, no, I do think you're right, though. It's not as if it's the equity that's taking the hit right now. It's not as if people are saying there's an immediate solvency issue for these companies.
Also, on the plus side, the fuel costs are going to be down big with this move lower in oil.
Now, while the virus has clearly been front and center among the top market fears, Tom McLennan of the McLennan Report thinks the sell-off could be, in part, attributed to politics. He checked back on how the market reacted to the Ebola outbreak in 2014 and compared the key events to that year to today's market. He sees similar price patterns. However, he's finding that in addition to coronavirus, Senator Bernie Sanders' successes in the New Hampshire and Nevada primaries were also key catalysts that pushed the market lower. He joins us now. Tom, great to see you. Thanks for joining us. We just sort of put up a quite complicated looking graph and a brief summary, but before getting to that, the other point that stood out to me in your notes was just how stretched you felt that we'd gotten before this pullback, regardless of what the spark ended up being for the pullback.
Well, yeah, there were several catalysts to give us a market sell-off, any one of which the market could have handled if it was on its own. We had the Fed pulling back from repos, we had the coronavirus worries, and then we had Bernie Sanders suddenly winning, and the people had to face the prospect of a socialist Democratic candidate for president. When you get all three of those put together, that seemed to be what tipped the cow over and was more than the market could take. And the market bottomed on the 28th of February, the day before Sanders won the South Carolina primary, and then the market got another boost after Biden did, and the market got another boost after Biden won on Super Tuesday, or won most of the elections on Super Tuesday. Today's pullback doesn't fit quite with that model, but the market seems to be happier facing a Biden prospect than a Sanders prospect. But we still have the problem of worrying about coronavirus, and we still have the problem of the Fed being too tight both on interest rates and on repos. They need to get with the program, and they need to do another half a point rate cut. Now is a good time. Why wait for the meeting to do the right thing? You can do the right thing anytime.
Well, they've done 50 basis points before a meeting. I guess, Tom, to push back on which of those factors you're putting the most weight on, you could say the politics has improved a lot. And the Fed has certainly improved, albeit you want it to improve further. And the one outstanding issue is the coronavirus. So do you not think corona's having a big weight on the market at the moment?
It certainly is. It's probably having a heavier weight on everyone's emotions and on their psyche than the actual effect on the economy, which is not unusual. We saw that with the Ebola panic in 2014. Everybody was fearful that we were going to all die from hemorrhagic fever, and the market sold off. And then when it finally seemed like things were getting, the authorities were getting a handle on it, then the market rebounded and made it all back and more. So that's the nature of overreactions to emotional issues like sickness and death. We are humans. We still have the caveman brains that cause us to react with fear to anything like that and not to act rationally. I'm not saying there's no reason for worry about the economy, but I'm saying that investors have a proven ability to overreact, and they seem to have done so in this case. You don't get a chance to buy a 40 VIX very often, or a minus 400 McClellan oscillator reading. Those don't come along very often, and they usually end up being opportunities if you can take the dead cat bouncing and flopping that goes on for the few days afterwards.
So what are you saying? That we've seen the bottom for now?
We have seen a bottom for now. We have another 2 weeks to go up into the FOMC meeting, but then we're going to have some more weakness into this summer, probably bottoming around June. But for right now, there's a chance we can get a rally that rips your face off just because we've stretched the rubber band so far. and we've had up one day, down the next with huge breadth numbers, positive and negative. That's a great sign for a bottom, but it doesn't have to mean a bottom you go up for years from. But it does mean that we have to have a big recovery as people start to get over their fears. Then we can get into worrying about how the Fed didn't do the right thing at the next meeting, and what's that going to mean for the longer term as we get more data in. And that'll be what gives us the next down leg into June.
Okay, Tom, great stuff. Thanks so much for joining us.
Thank you.
And
Very
tonight,
specific predictions.
June, done, easy. And don't miss tonight's CNBC special report, Markets in Turmoil, 7 p.m. Eastern Time. And now Costco earnings came out moments ago. Courtney Reagan has a breakdown of them for us. Hey, Courtney.
Hey there, Will. So this is a beat for the Costco quarter, and I think it's important for us to talk about this quarter ending February 16th. So for Costco's quarter ending February 16th, earnings per share of $2.10 beat Wall Street's estimates of $2.06. Revenues $39.07 billion, stronger than the estimates of $38.24 billion. Comp sales, again, for the quarter, up 8.9%, including gas, stronger than the street's consensus at an increase of 6.6%. Then separately, Costco also reported comps for the entire month of February, and for that, the comps were higher by more than 12%. And Costco specifically calls out an uptick in the fourth week of February, citing the increased demand related to the coronavirus, saying that they believe it added about 3 percentage points to that 12% comp. So two different comp numbers, one for the full quarter ending February 16th and one for the entire month of February. Shares of Costco are just marginally higher here, but we've been all over the map with this name as we have with the market. And then separately, if I can pivot us quickly to Gap, we have some news out of Gap Inc., the company now officially naming a new CEO. Sonia Singhal will be the CEO of the entire Gap company. She has been with the company since 2004. She was slated to run Old Navy in that previously planned spinoff that is no longer happening. However, now Gap has said that she will become the CEO of the entire company effective March 23rd. In addition, they've also named 2 new board members, both female, Elizabeth Smith and Amy Miles. Shares of the Gap are also slightly higher. Back over to you.
Quick question, Courtney. Does Costco always break it out like that, or were they specifically trying to highlight the impact of coronavirus at the end of February?
So Costco is one of the few retailers, Sarah, that still gives us these monthly comps. And so sometimes the calendar doesn't end clearly with the end of the month and the end of the quarter. So there are instances where they'll have to give us 2 numbers in the same release because the calendar doesn't line up end of month and end of quarter, and that's what happened here. And of course, the end of February ended up to be a pretty important period of time for Costco.
Got it. Courtney, thank you. Yep. Costco and Gap both trading up. Take your pick, Mike.
Yeah, I mean, Costco, basically at a high, within a couple of dollars. Very rare. Obviously, a 9% comp for the quarter. Whatever the effect was at a company this size is still pretty impressive. So that's kind of in the sweet spot. Gap, the market's valuing companies like Gap as if they're not really fixable. So we'll see if there's a new CEO. Seems like obviously from the better part of the business gets a little bit of help.
There was some hope of splitting this company up.
There was, and then they kind of sort of retreated on that plan. It's not clear that would have been, necessarily a panacea, but cheap stock, very cheap, and still pretty decent cash flow metrics and all the rest of it. The market just doesn't want anything that has more than 1,000 stores basically.
Well, and everything's on sale at all times. Gap at Old Navy. All right, let's take a look at how we finished up the day on Wall Street. Another brutal one for the bulls. The Dow closed lower by 969 points. That was a loss of 3.5%, a little more than that. S&P 500 down by 3.3%. Every group in the S&P was lower, led by financials. Got hardest hit there. NASDAQ down 3.1%, and the Russell 2000 index of small caps down 3.4%. This as we saw another massive rush into the safety of U.S. government debt, taking the 10-year yield below 1% to a new record low. Let's get to Meg Terrell for the latest details on the coronavirus outbreak. Meg.
Hey, Sarah. Well, cases worldwide, they're inching closer to 100,000 as even As China's new daily case counts decline, numbers are mounting in South Korea, Iran, Italy, across Europe, and increasingly in the U.S. Schools closing in some capacity in at least 22 countries, affecting more than 290 million students, according to the United Nations. Of the more than 97,000 cases worldwide, Johns Hopkins data show about 54% have recovered and more than 3,300 have died. In the U.S., case counts jumping today, led by New York and Washington state. New York cases doubled to 22, while Washington, Seattle, and King County reported an additional 20 cases and 1 death. Total U.S. infections now approaching 200. This as testing capacity has expanded here, and that'll continue as commercial companies make their tests available. LabCorp just now saying its COVID-19 tests will be available starting at 6 p.m. tonight. Earlier, Quest Diagnostics said its test will roll out on Monday. Finally, the Senate overwhelmingly passing an $8.3 billion spending bill for the coronavirus response today, sending the package to the desk of President Trump. Wolf?
Meg, quick question. Why is the U.S. having so much trouble getting testing when South Korea has tests, China has had tests? I mean, why is this so difficult for us?
There was a delay in the rollout of the CDC-developed tests such that when they were starting to be used by the public health labs and validated, they didn't work. So the CDC has had to replace some of those. They've had to figure out workarounds. So that caused a big delay. And now they're changing regulations so that labs can develop their own tests and commercial companies can work faster to ramp up their testing. But this has all been kind of delayed by that initial rollout at CDC.
Meg, thank you so much for that. And tomorrow, by the way, you don't want to miss this, Secretary of State Mike Pompeo will discuss the coronavirus and much more, 8 a.m. Eastern Time on Squawk Box. Let's get over to Mike for the third installment of today's Dashboard. Mike.
Yeah, Wilf, in reaction to this tough few weeks we've had in the market, professional investors starting to trim their sails a little bit, reduce exposures in a pretty radical way. This is a weekly survey of the National Association of Active Investment Managers, very tactical, kind of short-term professional investment advisors, and this shows you the percent of equity exposure that they're holding right now. Really plunged here. That is most significantly below the levels we even saw in late 2018. We had that 20% decline in the market over the course of 3 months. So this should be taken, I think, as a net positive in terms of just the violence of the cutback in exposure. It doesn't necessarily line up with every other bit of positioning and sentiment information, but it's starting to get in that direction of people are scared and they're playing very small in the markets, and that speaks to this volatile environment. So at least it's creating the setup for a sense that that folks have basically done a ton of selling in a short period of time. Maybe it'll find its footing.
So it's a mixture of market moves and actively withdrawing cash, or?
Exactly, yeah. Yes, it's both, but mostly it is discretionary moves that really creates a decline in that bit.
Okay, Mike, thanks so much for that. Here's a check-in on the closing bell big board. As you can see, we traded down sharply. The major averages were down about 3.4%. Industrial's the worst performing sector. And here's a look at the laggards within that group. Airlines, of course, suffering sharply, down 13% for United and American.
And it hasn't just been today. Airlines have been one of the hardest hit sectors ever since the coronavirus outbreak started. United down nearly 10% today after the company announced it was cutting its flight schedule and freezing hiring. Meantime, Southwest says it could see up to a $300 million decrease in revenue this quarter. And CEO Gary Kelly says they're seeing a noticeable drop in bookings.
It was a very noticeable, precipitous decline. It's continued on a daily basis. Hopefully this won't last very long.
Joining us now is Gordon Bethune, former Continental Airlines chairman and CEO. Gosh, these stocks, Gordon, have been hammered very hard, down 30% just over the last month. What sort of financial pain are these airlines in for?
Well, I think in the short term they're in for some pain, although there's a big long upside at the end of the day here. This is not going to be forever. I know it'll seem like forever, but if you look out 3 months, there's a lot of upside, the return of the Boeing MAX and the return of growth in the airline business. So I'm okay with it. I do understand in the short term, because it's a cash issue, that they do have to take some action, and all of them are doing that.
What type of action do you expect to be taken from here? I mean, this is an evolving story. We don't know how many cases there are going to be in the U.S., but the gut reaction appears to be sell the airlines on the fact that more companies are going to cancel travel and more consumers are going to cancel travel.
I think that's true, Sarah, except for the fact that there are antidotes to this being developed and testing that gets better information out there to the panic that kind of pervades our country now. I mean, a couple of hundred people in 2 million or 200 or 300 million people is not a big number, but the fear factor, subjective as it is pretty widespread. So that's not something a rational person can project. It's an irrational fear. It's going to get worse, and I think we all know that.
Gordon, how do you think about these stocks in terms of their valuations? The price to earnings multiples, I mean, albeit with the E part likely to fall, are in the low single digits. Have you ever seen them like that before? I mean, I guess only at times when people have questioned whether they were going to go out of business or not. Is that a possibility?
Well, I've been there, so I've seen it, firsthand, but you're right. I think the fundamentals of the airline business are good. I really believe the fundamentals of the economy are good, so they're going to tie in with that. This short-term hyperventilation about coronavirus is not a permanent issue in our country and won't be in the world. So it's going to recover, like was mentioned earlier. We just don't know how far down it's going to go.
So I believe you were still in charge of Continental during 9/11, and that was another period people look at as to when airline travel just stopped. What was that like, and do you see any parallels now, and just in terms of consumer behavior and how the airlines might prepare or respond?
Well, Sarah, at the time, it wasn't the end of the world, but you could see the end of the world from where we were, and it felt like that for 8 months. I think a long pull through that, really traumatic in the airline business. This, I think, is less so. I think it's going to be faster moving, hopefully, because ostensibly in the summer season, these types of viruses abate. There are antidotes to them developed and better testing. So there are a lot of good things that will mitigate the problems we're having today. And I think that'll be reflective in long-term or this year's earnings for airlines.
So, I mean, clearly there's been no restrictions on flying, Gordon. Would you send your kids overseas for spring break? I mean, what should Americans be doing?
It depends on where overseas we're talking. As you know, there are some countries that have zero and probably are likely never to be affected by this. And there are things like in China and Italy. Well, in different parts of Europe, there are very, very different outcomes. There's no cases in Denmark, and so I'd be selective. And I guess, in fairness, when you're talking about your children, you're probably a little more conservative than you are about yourself. So things I would do, I wouldn't want my children to do.
Gordon Bethune, thanks for joining us.
Okay, Sarah.
And don't miss the CNBC special report, Markets in Turmoil, tonight at 7 p.m. Eastern.
Let's get back to the broader markets and the whipsaw action we've seen over the last couple of weeks. The S&P has moved at least 2.8% every single day this week, alternating between gains and losses. Bespoke's Paul Hickey says markets will remain unsettled and joins us on the CNBC Newsline for more. So, Paul, break it down for us in terms of that level of volatility and the huge moves that we've been seeing. How much longer do you think that'll go on for?
I think, Wilson, in the short term, we don't know what's going to transpire over this whole thing, but during these types of shocks, what we saw in 2015, what we saw in 2011, the most recent two periods where we saw similar volatility, you've tended to see a couple of weeks of this. So it wouldn't surprise us to continue to see this over the next week or so. Despite all the volatility we've seen, I mean, you'd be surprised to hear that this is actually the second best week of the year that we're having for the S&P 500 so far. So it's been about 2 steps forward, 1.9 steps back, but ultimately the net has been positive this week. So as long as we can continue to see that type of pattern, that's encouraging. The big test obviously is going to be tomorrow, because we all know the headlines are going to get much worse before they get any better, just because we're testing more people, so the number of cases is going to go up. We haven't had a Friday that has been positive this year since this outbreak really came out. So, investors have been very hesitant to hold stocks into a weekend. And so if we can see any sort of stability tomorrow, I think that would be a real positive signal. In the short term, you tend to see the volatility, but in the long term, As we've noted in a number of studies, and Mike Santoli was talking about yesterday, referencing another study, that you tend to see this flopping around like a fish in the short run, but eventually the market rights itself.
Well, what do you make of the level of the move, the scale of the move we've seen in bond markets? And the question people keep saying is, are they moving ahead of stocks, i.e. that we've got much more selling to come in stocks?
I mean, I think right now, I mean, if you're buying bonds, you're definitely not buying them as an investment at this point. I think you're pretty much buying them, on the hopes that someone else is going to buy them from you at a higher price here. The long-term U.S. Treasuries are in the middle of one of there's only been 7 other days since 1987 where the year-over-year return was greater than it is right now. It's 32% in the last year. When you've seen long-term Treasuries rally by 25% or more in a given year, you've tended to see equities outperform Treasuries over the next year just about every time by an average of 14 percentage points. So, I mean, the bonds are reflecting the uncertainty out there. We're not going to sugarcoat it. There's a lot of uncertainty out there, and investors are right to be uncertain. But, Treasuries have rallied on that. Equities have sold off on that. And the question is, can equities look through the coming bad headlines we're going to see over the next coming days as the number of cases goes up, number of school closures increases, and travel disruptions rise. But again, we don't know when that's going to end. But I mean, just looking at China, Starbucks is just announcing right now that they've seen the worst in China. They haven't seen any impact yet on their U.S. operations. So, I mean, I think that's something we just it's a wait-and-see game. The market hates uncertainty. Unfortunately, we have tons of that right now. But I think just like every other crisis we've experienced throughout history, eventually, we'll look through this and get past it.
I mean, we're not in a place, Mike, now where the market is looking through headlines that Paul was just saying.
No.
I mean, what would it take to get there?
I think it'll take time and just continuing to whip around these levels and see if the market can withstand it. We're still talking about headlines that say 6 new cases here, 4 cases there. It's not like we have a handle on the aggregate trend in all this. And so I do think that, I go back again to the post 9/11 2001 example where for a time you had these stray headlines of a bomb scare here or travel restrictions on an ad hoc basis, and for a while the market was very jumpy and jerky about that. And I just don't know that we've had enough time since this became the dominant storyline in the markets for us to be saturated with it for long enough that we say, okay, we got this. We kind of know where it's headed. But in terms of the actual tactical dynamics, as Paul was saying, it's kind of textbook in terms of, one sort of big reversal off a low, and then we have to maybe hash around there and test it down the road.
All right, Paul Hickey, thanks for jumping on the phone.
Okay, sure, thanks.
Still ahead, investors may prefer Joe Biden to Bernie Sanders, but a closer look at the former vice president's tax plan shows a big hike could be on the horizon for wealthy Americans and businesses.
And it's getting so bad for oil and energy stocks that one financial firm says they're giving up on the sector. As we head to break, here's a look at the biggest losers in the Dow today. We're back in a couple minutes.
com.
Welcome back. A quick check at how we finished out the day here on Wall Street. Down sharply, but off the lows, which was more than 4%. We closed down 3.4% on the S&P 500. And of course, the perspective that we are up week to date, 2.4% on the S&P 500. It's been lots of up and downs alternating over the 4 trading days so far this week. Now, new details on the cost of Democratic presidential candidate Joe Biden's tax plan. Elon Moy is here with more on that. Hi, Elon.
Hi, Wilfred. Well, let me break it down for you in 3 big numbers. $4 trillion. That's the total size of the tax increases in Biden's plan, according to a new analysis from the Tax Policy Center. $1.3 trillion of that comes from raising the corporate tax rate from 21% to 28%. On the individual side, the tax hikes would mainly hit the wealthy. The top rate would go up, capital gains would be taxed as ordinary income, and the payroll tax would apply at higher levels. For the top 1%, it all translates into an average tax increase of $300,000. Guys?
Not sure that's going to prevent him from getting wealthy donors, Elon.
That's right. Well, I think if the alternative they're looking at is Bernie Sanders, well, certainly I think that Joe Biden is still preferable, but I think it is important to remember that he still wants to raise taxes on the wealthy. So it doesn't mean that the wealthy would get a free pass under Joe Biden. It just means that some of the more aggressive proposals from Bernie Sanders wouldn't see the light of day.
Elon, of course, traditionally there's always a bit of tacking to the centre once somebody's won the nomination. Are tax plans, when you've been so specific and given such clear numbers on them, are they usually included as well in terms of things that get watered down a bit or not?
Well, you know, I think that actually Biden has left himself some room to do even more, perhaps. So, for example, the Tax Policy Center's analysis does not include something like a financial transaction tax, which Biden has signaled that he's open to, so we could see some more details fleshed out around that. That would be something that I think would be considered perhaps more left of center and give him room to be more aggressive if he sees that Bernie Sanders is perhaps playing better than him in the polls.
Elon Moy. Elon, thank you.
Thank you.
Energy getting slammed again today. The oil and gas ETF falling nearly 5% just in today's session. Jefferies analysts saying today they are, quote, giving up. Brian Sullivan here with more on a day where OPEC actually took some action.
Yeah, they hope it takes some action. I mean, it's a 1.5 million barrel per day proposal, effectively. Of course, Russia tomorrow will join OPEC, what they call OPEC Plus. We'll see if they can really get that done, although there's a big school of thought out there that OPEC, which has been really tied at the hip of Russia, may just go ahead and do whatever they need anyway, Russia or not. We'll see. That would, of course, involve Saudi Arabia taking an even bigger thing. Here's the reality, guys, is that we fell again in oil today despite that because the market wants something concrete out of OPEC tomorrow. We get that. Nobody's saying the price of oil is going to rally, but it might stabilize. If we get out no deal at all out of Vienna, and everyone just goes home on Friday, everybody I'm talking to says oil could and will likely plunge tomorrow. We could see stocks and oil fall even more tomorrow. What's interesting, guys, about the stocks is that, I mean, they've been crushed. In fact, here you go. The average return of one of the 6 companies operating in the Bakken, which is up in North Dakota, is 57% loss this year. It's March 5th, and these stocks have lost more than half their value on average. I could look at my screen and find stocks that are down 75 and 80%. Obviously, the market is saying, unless oil recovers or moves higher, some of these companies, their equity anyway, are likely going to go away. So tomorrow will be another big day, but pretty much everything's red on the screen as well. And oil stocks as a group, guys, Wolf and Sarah, are now trading below where they were when the price of oil was at $25 a barrel. So something's off, but everyone hates it. ESG, high debt, you name it, no one likes it. There you go. I'm starting to feel bad about myself every time I do an oil hit. Or I should say
Brian,
worse.
my sector's suffering too. Not quite as badly as yours, but I feel your pain.
Oh, but brother, mine is attached to yours. See, because you hold all the debt. And so when all these companies can't pay their debt, then your sector, you're next.
Yeah, well, we're already on that path, that direction. Brian, thank you so much. We look forward to the show at the top of the hour. Mike, just one follow-up question on this, which is that clearly with the dollar coming down, with stimulus being announced, China in particular stimulating, you would have expected oil to rebound a bit better than it
How
has.
about the fact that
the
there's
industrial
an agreement from OPEC that they want to cut
Right.
1.5 billion barrels per day.
Industrial metals have rebounded quite significantly,
yeah.
Relative to oil, but oil just can't catch a break.
Well, I mean, the price and the consumption have gone down so much. And now, I mean, if you look at our travel stocks, I mean, what is that implying about demand even in this country, right? So yes, China perhaps has bottomed in terms of activity and therefore the metals demand and things like that. But it just doesn't seem as if the supply cut is necessarily getting ahead of this issue.
And even if OPEC convinces Russia to go along with this agreement,
I mean,
then
I think we're getting into trading psychology, and certainly you can get a bounce. And, you know, it's not as if the crude oil was still in the mid-40s, right? So it's not like it's completely at washout levels.
Still to come, a sea of red across all the major indices today. Mike's going to head to the Telestrator with a look at the key economic indicators to follow coming up.
.com.
Another day of selling on Wall Street. Dow closing lower, 969 points. Let's go back to Mike Santoli for his last nautical-themed dashboard of the day.
That's right, Sarah. Asking if maybe the tide is set to turn now. We haven't really spent a lot of time talking about the reported macroeconomic numbers. We are going to get a monthly jobs report tomorrow, but the backdrop for the labor market, of course, has been strong. But here's where the dynamics come in terms of forward-looking trends. So in orange here is continuing unemployment claims, not new claims. So continuing basically the number of people collecting uninsurance, it's very, very, very low, just like unemployment in general. So we're bumping along historically low levels. The top chart here, the JOLTS, this is the number of job openings reported by businesses, and this obviously has rolled over pretty dramatically. And if you look at past cycles, when it rolls over, the orange line kind of comes up, right? So that's your pre-recession indicator. The big question, obviously, is what effect a lot of the measures related to coronavirus are going to have, either temporarily or more lastingly, on the jobs market. So I do think it's something to watch, because it doesn't take much to get the Wall Street conversation to go back to how much is left in the tank for this expansion. And I do think that this is the kind of thing we're going to be watching, even though the labor market remains in a very strong position.
Would you have expected to see this show up in the weekly jobless claims numbers yet? The fact that companies are canceling business travel and conferences and
not quite yet. I almost wonder if next week would be the one where you saw it. I mean, you're going to kind of cancel things before you lay people off. So today's numbers you mentioned earlier, though, the new claims was actually better than expected by a little bit.
Mike, thanks so much for that. Still to come, the countdown is on the February jobs report due out tomorrow morning. What Wall Street is expecting when we come back. Welcome back. The Dow closed down 970 points, 3.6%. It was off the lows of the session, which was down over 1,100. We're down over 4% on the Dow and the S&P at the lows of the session. The last 30, 40 minutes or so took us back to just down 3.6%.
still remarkably higher for the week.
Yeah,
Even though these
2%
days
plus higher for
are
the
so
S&P.
huge. Just want to check in on shares of Costco reporting after hours. Stock is a little bit higher. That's sort of where it's been the whole time. Interestingly, breaking out the 4-week of February, showing the tick up in business on the last week of February as people rush to Costco and stock up on toilet paper and bottled water and whatever else
Yeah,
they're getting in bulk.
Obviously, it almost was the perfect chain to actually catch most of that business. So not a surprise, tremendous double-digit gain in comps for February. But I just think that it's always been a very well-managed
12.4%.
company that could continue to show good growth in normal times. So almost just an accelerant there.
Looking ahead to tomorrow, we'll get the February jobs report projected to show payroll increased 175,000 last month. That's compared to January's 225,000. The report due out tomorrow morning at 8:30.
We haven't even talked about those jobs data.
I know,
It's
nuts.
crazy.
But Mike,
it is amazing.
Could it be, if it was 3 million, would it be possible we wouldn't see a rate cut in 2 weeks?
I don't know that we have 3 million people to.
I know, but
hire
I'm just
February.
saying. But to Sarah's
but
point,
to your
is it
point,
irrelevant?
No, it's really not relevant. I mean, of course, when you consider the survey week from which the report is drawn was not in late February, so it's not really giving you a window on any of the impact we've had of this sort of slowdown and business restrictions and things like that. So, but it does help give you a snapshot of where the economy was before we got into all this, and it was relatively sturdy.
I was just going to say, and the data points that have been coming in, ignored by Wall Street, but have been mostly pretty strong.
The
So
ISM,
thinking that it doesn't
non-manufacturing.
matter what kind of a footing we're even coming from, because the downside of this could be so bad.
Well, I
for
do
the
think it
economy.
does matter. It does show you that we're maybe in a somewhat less fragile position than we might otherwise have been, and therefore you can withstand a little more. But ultimately, it's not going to determine exactly how the economy bumps along from.
See, it
here.
seems like the investors and the Fed are watching the virus numbers
Exactly.
and not so much the
Watching the
jobs
virus numbers and watching signs of financial stress. Now, the stock market being down a lot is one of those things. Credit markets getting a little squirrely is another one. We'll have to see if that continues.
Mike, just remind us of the key levels to watch out for tomorrow and the fact it's a Friday not to break below. And
I think in general, last Friday's low was 28.55 on the S&P. It's about, 5% down from here. I think you can go on the premise that that might be the low for the short term, but it still has to prove it's the case.
And Fridays are usually not great, right?
They haven't been
Brace
good
for
all
negative
year.
headlines
Absolutely.
in the weekend.
we are out of time. Don't forget to watch the special tonight, 7 p.m. But thanks for watching Closing Bell.
Fast Money starts right now.
These clocks don't agree.
Another big sell-off rocking Wall Street. Fears of an economic slowdown sending stocks spiraling. The Dow dropping 970 points for a loss of about 3.6%. Every S&P 500 sector finished the day deep in the red. And more incredibly, the move in bonds. The 10-year yield at one point hitting 0.899%. Remember, it was 3% just 2 years ago. The drop leaving many investors on edge that the bond market may be predicting a recession is coming. The Dow has now lost 2,400 points in just 3 weeks and is now just 1.2% away from wiping out all of last year's gains. Most other indexes, they already have. Your team of fast money traders tonight: Steve Grasso, Brian Kelly, Karen Fineman, and Guy Adami. I'm Brian Sullivan. All right, Guy, I don't like to use this word, but is part of this market, investors, panicking?
No, I don't think. No, I mean, again, panic is the wrong word. We are within 7 or 8% of an all-time high. If people sold stocks, given the run we've had over 10 years, is that panic? The speed with which things are moving is clearly scary. I don't suggest that it's panic. I don't think you've seen panic yet, and quite frankly, our job isn't to stoke the flames of those panics. It's also not our job to assuage the concerns. We're trying to tell you what we think is going on. And with the VIX at 39.5, given this backdrop, given the fact that people are not traveling, they're not going to games, schools are closing, that is a fact now. We talked about it last night. That's going to have a huge effect on the economy and a subsequent effect on the market. I've said for a while, I'll say again, I think Steve agrees, 2850 or thereabouts in the S&P is a big level. That's about 7% from where we are, and that to me still makes a lot of sense.
We will get to the numbers, the technicals, because there's really stuff going on in a second. But I want to go back to that idea, Karen, and I wasn't suggesting in any way to stoke it. I didn't use it to stoke it. In fact, just the opposite. What I'm thinking, Karen, is you don't want to buy generally until things flush out. Do you feel like we are or are getting close to being flushed out?
I don't know, but since I am a long-term investor, I do feel like, all right, I have to be dipping my toe in the water here. I have to be starting to buy stuff. It's down a lot. This is the part where you're so scared to own anything and your gut is to just sell everything. So what I did do today was sell some puts, right? That's my protection. That's my insurance. And yet I feel like, wow, with the VIX up here, it was 41 too late in the day. That does feel panicky to me. I mean, just think about this. We are almost exactly where we were 2 days ago at this time. And yet, if we had seen flat yesterday, flat today, and ended up here, that would have a very different feel to it than what's happened in the last 48 hours. That's a difficult market to trade in, but I feel like the risks are just as much to the downside as they are to the upside.
Still.
Some kind of coordinated surprise. Yeah, I feel actually as we go lower and lower, I think the risk of an upside shock is actually.
I think the problem, though, is to your point, is it panicky? Do you feel panicky? I think people are getting panicked over this virus. I think that I'm not a scientist, but it does feel overdone on the panicky side of the worries about the virus. As far as the marketplace, we were down 15% to that 28.55 level, smacked it on a dime. That was the low from October. So that's the low you have to look at. If we break that, then all hell could break loose in the overall market. Then you're going to see panic. The problem is you haven't seen a great flush day. Because to Karen's point, you're down 1,000.
That's what I asked. This was not a flush day.
Well,
I know we
here's
rose yesterday.
That's the problem. So you get a flush day where you're down 1,000 points and then you rally 1,000 points. So that's confusing investors because no one understands what changed in a 24-hour period. And this is the way markets do act while you're trying to research a bottom. I don't think we're there yet. But I do think people are getting over-panicky about stuff that they shouldn't be. Some of these giant swings are, and we've been talking about this for months, the Wall Street Journal actually had an article about it today, lack of liquidity. So some of these swings, even on the upside, are weird things like people raising collateral, you've got ETF mismatches, that kind of stuff. These are all leveraged accounts that the average person has no ability to come in contact with. I rarely come in contact with them, but what happens is they wind up exacerbating the move. So they get triggered buy stops on the upside on an intraday high. They get triggered sell stops on a low, on an intraday low. And that's what confuses most.
Yeah, but I wouldn't characterize what's gone on over the last 2 weeks, and I don't think you're doing this, but I would not want to characterize what's gone on over the last 2 weeks as simply just levered products creating volatility in the market. There is an actual economic impact going on here, and that's not to minimize the health impact, but because people are uncertain, because people are canceling schools and not flying, that is a real economic deflationary shock. Now, we don't know how long that's going to take, and part of the reason why, in my view, the market is so jittery is because of the uncertainty.
Yeah.
How do I price that? What price do I put on a 3-week stop of travel? What price do I put on a 6-week stop of travel? Nobody knows.
Well, and I think that's where we've maybe been wrong. And I think that I was watching coverage today in the show, and you notice I didn't say coronavirus fears. I said recessionary fears, because I think that's what it is. We're getting a lot of comments, people on Twitter, they're saying, oh, the virus is small and it's survivable. And those things right now are very true, thankfully. The markets are not down because of coronavirus. The markets are down because of the economy. Right. And the economy is being looked at shakily because of the virus. I just wanted to say that because I think people, they misinterpret it. 33 billion Chinese tourists brought in terms of dollars, 2018. Chinese tourism's down by what, 95%? Just do the numbers. That's what we're talking about.
Right, and we're not, none of us are trying to discount the health portion. Our job is to talk about the financial impact and the subsequent impact on markets. And to BK's point, I'm not making it up when I say I was supposed to be at a conference in Chicago at the end of the month of March. That conference has been canceled. That means I won't get on that plane. That's not just me, that's a lot of people. Now, sporting events, museums, cinemas, you can just start doing the math in your head. Fewer and fewer people are going to start to go out. Whether that's justified or not, I can't say, but it is absolutely real. So the market should. Now, by the way, and we've talked about this, in my opinion, the market was on extraordinarily shaky ground before we ever heard of the coronavirus. And I think, to your point, this was just a trigger to get us to where we are now.
But if you really think about it, though, when you start to look, nobody can quantify how many quarters it's going to take to get back to it. But the pushback I have is that every time you see a coronavirus headline, the market does shake out. So it's sort of a chicken or the egg type thing for me. And when you start to look at what the economic impact is going to be on the travel industry, on the airlines, on the hotels, there's going to be a lot. We don't know what type of relief there's going to be. This is where there may be some opportunity. Let's go there. Okay, let's talk about American Airlines. And I'm not picking on American, but they're the hardest hit of all the airlines. American Airlines stock is down, I think, 40%. Crazy. In 1 month. In 1 month. So, but we'll get people that'll tweet, I was on an American flight yesterday and it was packed. True, because the market is saying in a month it won't be, or that flight won't exist because they're going to cut capacity. Well, so one of two things is going to be spectacularly wrong. Do you believe the economy in a month Karen, will be down 20, 30%? Because that's what the market is predicting.
20 or 30. No, I don't. But I think, though, that the airlines, we talked about this a couple days ago, have a unique business model that is particularly not good in this kind of environment where you have heavy fixed costs, right? You own the planes, you have the labor. Those are big costs, right? That infrastructure. Oil is down. I understand jet fuel's cheaper. But when you have a contraction in a model like that, that's worse than, people not going to a retailer. That's worse.
Yeah, look at American Airlines lost, and United, if you're on the radio, you can't see the graphic, Guy, lost 13% today.
Yeah, I understand.
On top of 35% declines coming into today.
Delta Airlines down 7.5% today. And, we're coming into a period of time where we're going to know a lot more over the next couple of weeks. I think your point. I mean, don't discount the fact that now a lot of schools are going on spring break. This is typically a time of year over the next 3 weeks when people do travel as families. Let's see what happens there. I suspect families aren't going to travel like they have in the past. Let's just see. I'm not trying to
all
stoke
of your
the flames.
time in the markets. This is a systemic selling that I have only seen a handful of times during, obviously, flash crash when we saw it during the financial crisis. But this is a systemic selling that I've never witnessed, and a systemic buying that I've never witnessed in my almost 30 years on Wall Street.
This is why we've been talking about this
and
idea.
one more thing, I know you want to get in. One more thing, the irony of this whole thing is that everyone keeps thinking about the next leg down is going to be when we start seeing thousands of more cases that we didn't know about. The irony is when we see the thousands of more, that death rate is going to shrink. And I think that's where you're going to see the bottom in the market when we see so many more cases.
Because the market is the market, BK, is already looking out to that potential.
I think what the market, to me, this is classic inflationary spiral behavior. So give you an example. We're talking about the airlines. I'm supposed to fly in the middle of April. I haven't bought my ticket yet. Every day I check it, the price keeps going down. The price keeps going down. If everybody keeps doing that, that's the deflationary spiral, and that's what the market is trying to price in. So how does this end? The upside, to Karen's point, the risk here is you have a president whose scorecard is the stock market. So eventually, there is going to be something coming from the White House. It has to be a health solution, not a financial solution, but we'll get that eventually. But again, nobody knows when, and until then, you continue this deflationary spiral.
Well, one thing we have learned about the American consumer is that she and he are exceptionally resilient, and that when things pass, and they will,
I agree,
they go back. Cruise lines, they're down 50%. I understand there's sort of the not thing that you want to be thinking about right now, okay? But I remember there have been other situations, and you look at it, and in 3 years, are people going to remember this? They're going to still book cruises, are they not? And then RCL and CCL might look doggone cheap.
That's not a crazy thought at all.
Thanks.
Right, very good. Yeah. No, what happens in the interim? I mean, yeah, I love to look at value. I'm not looking at the cruise lines yet. Maybe I should.
Not yet?
Not yet.
What's it going to take?
RCL is down 50% year to date. So I hear you and I hear Karen. And Karen, what Karen mentioned about the airlines, before we even got into coronavirus headlines, the cruise line had a bunch of headwinds thrown at it as well. So that one could take longer than the other trade. But I do agree with you and Karen. At some point, it is a buy. It's down 50%.
Not yet. 'Cause I'm trying to find some
It's getting extremely close, down 50% off.
At some point, you're going to buy unless they go out of business, you're going to buy the equity. That's
Correct.
it, right? At some
Correct.
point. All right. Maybe that's not here. Karen says no.
I don't know.
Thank you for the compliment. That's not crazy. That's a compliment from Karen. All right, the breakdown in yields raising new concerns in the credit market, as if we didn't have enough to worry about. Let's bring in Steve Leishman to talk more about this, where health crisis, sort of market semi-crisis, now bleeding into credit problems.
Yeah, I mean, it's just a natural extension of what's going on if you think about it, Brian. Fears of recession, fears of a decline in revenue, fears of decline in sales and profits raises questions in this world of highly leveraged companies with a lot of debt out there. Now, look, going into this, every appearance is that they were in pretty good shape. There was a lot of debt out there, but the economy was doing pretty well. The coverage ratios were pretty good. Some of the debts or covenants that were written were kind of on the, iffy or light side. But we talked to all three major credit rating agencies, and they all, for lack of a better term, have the hair standing up on the back of their neck. There will be more. S&P told me that the pace of downgrades will quicken. Fitch has yet to downgrade anyone because of the coronavirus. Only 27 companies at S&P, say of a universe of 4,000 corporates, have been downgraded because of corona. Who is it? Well, it's Samsonite and Sabre, travel and tourism related companies, some of the weaker airlines. When you get into the sovereign space, you want to look at countries, for example, that get the predominant of their revenue to service their debt from tourism. You want to look at commodity companies and commodity countries. Those are the ones, you know what's going on in the debt of the oil patch better than
And there was
those
some
guys.
action today, by the way. There's some midstreamers that were able to sell some debt or at least raise some debt today. But I want to bring up one instrument too, because you're always trying to look for like a litmus test on certain things. The BKLN looks like Brooklyn, but it stands for bank loan. This is a bank loan, Invesco Senior Bank Loan ETF. Steve, and I think if our audience wants to look at one thing going forward for some sort of a litmus test, look at that. That BKLN, it's just my opinion only, but I think that's the one you want to look at because it's full of, investment grade and mid-speculative grade. We haven't seen it trickle through yet. You're saying we may be at the beginning where
everybody's on watch right now. Look, this is not the financial crisis at this point, and there's not an expectation it becomes that. But the idea that there will be downgrades, and investors need to just sort of be careful. If a yield on a corporate bond looks too good to be true, it probably is. If a dividend yield on a stock looks too good to be true, there's a reason for that which can probably be found in the balance sheet of the corporation.
Steve, you're talking to both central bankers, rating agencies. Prior to this, we had weakness in Europe. When I look at the European banks, the charts of the European banks, they look awful. They're on the cliff of death. Is anybody concerned that perhaps this tips Europe into a deeper recession and the European banks have an issue?
Most certainly. And I will tell you also going into this, Fed officials were already, before this, complaining about the high levels of corporate debt in the U.S. Let me give the other side of this, which makes the short in this market a bit of a wild card, which is yields, spreads have risen for some of the high-grade yields of the speculative credit, but interest rates are also down. So that helps with the cash flow. The other thing is there could be bailouts. The IMF and the World Bank came forward and said, we put out the welcome mat for countries that are having trouble. So that's an important issue that something looks like it may go down. It's possible it could be helped by a bailout. Europe is another issue all unto itself.
So the high yield market here, are there any big deals that are pending or? I mean, I haven't really seen that much activity in the last few days.
I think you haven't seen anything because there's nothing to see. I have read an enormous number of debt research reports recently. I think I saw something that said there have been either no deals or one deal in the last several weeks. I have to go back and check. I will let you know. But there aren't deals out there, which raises another question, which is the question of liquidity. There will be some companies that have to roll over their debt, and they were structured in a way that, hey, the credit markets are open, no problem rolling. That could be a problem if they come to roll and they can't roll because liquidity is dried up. This is a problem, a potential problem in the speculative grade credits, not in the investment grade. When I look at the walls, which are what comes due when, investment grade is a couple years down the road. They have been smart mostly over this period of time of low rates. They've done what we call termed out, which is they've extended the debt and refinanced it lower on the investment grade.
Steve, it's easy to take pot shots at the Fed. I'm not here to do that, but I want to ask a question. Hopefully it's not too convoluted. Steve mentioned something, hasn't seen this in his career, where you have 1,000 points to the upside, 1,000 points to the downside over a matter of days. I would suggest it's a function of complacency built up over the last 10 years as manifested in a volatility index, because in my opinion, the Federal Reserve has been the backstop and people have gotten lazy in terms of the risk, thinking the Fed has our back. Now you have a VIX that went from 14 to 40 and people are paying the price. Does the Fed, do you think they acknowledge that maybe they've added to the complacency of what's been an extraordinarily complacent market?
I think there's concern about that. Eric Rosengren, the Boston Fed president, has spoken about this. He was opposed to some of the rate cuts we recently went through because of that reason. He was one of the guys, by the way, before the market got spooked, who flagged WeWork as a problem, as an issue out there. He was concerned about that. There are those who are concerned. I will tell you their operational standpoint in the face of this is what's called Can I get a little music? Macroprudential, just to make it more palatable. The idea of doing it from a supervisory standpoint, get on the banks for holding too much speculative stuff on their books, so that you don't have to adjust monetary policy to keep the economy from going into a bubble that could burst. That's been their idea since the financial crisis. Will it work? Well, we haven't been through this yet. We perhaps, and unfortunately, might find out on the backside.
Steve, second time at the NASDAQ today. I believe you're on this morning with
so much fun here. And going over the George Washington Bridge is maybe one of my favorite things to do.
A couple times a day. That's not deflation.
Does sarcasm translate?
$15, coming in or whatever.
Does sarcasm work on TV? I don't know.
Steve, thank you very much. Good stuff. Appreciate that. Look at the HYG high yield ETF BK, the BKLN, what we just talked about, the JNK. Anything else you're watching?
So the BKLN is really an interesting one here because Steve just talked about the fact that the Fed is concerned about the banks. My view is I don't think we're going to have a problem with U.S. banks. All the fire trucks are right outside the banks with their hoses ready to go in case there's a fire. That's not where the risk is. The risk is in these leveraged loans. The risk is on investment managers' balance sheets. The risk are in foreign investors that have invested in these things searching for yield. So I wouldn't worry about U.S. banks whatsoever. I would be worried about all the other stuff, these leveraged loans and those type of things, and even in the oil patch, those type of things. That's where you're going to see if this health crisis turns into and morphs into something else. Again, I don't know if it's happening. I'm not saying it is, but that's what investors have to watch to see if it starts
this is
to
going to
morph.
sound grotesque, but there are some financial predators out there that have outcomes that they would like to see occur.
Sure, there are.
You know what I mean? And if you're looking to
Black swan, yes.
This is not to say people are out there saying, but like think about it nowadays, all the instruments, right? It used to be if you want to short a stock, you shorted the stock. Now, you don't like a stock, a dummy corp, you short it, you short the ETFs that you're in, and then you buy the triple short a dummy. There's all these instruments you can use to just
Right. And
like
the
that's
problem
like
is-
Tyson's
the problem
one shot.
is
Remember
what
that
Steve
body blow, knock him out.
The problem is what Steve just said, where he left off saying they're thinking about there could be a bailout, which turns that whole scenario on its head.
Yes, and then
it
we go,
keeps,
boom.
Exactly, it keeps people a little held at bay when you start to see these are transitory, hopefully transitory issues that you might see a bogey taken on a lot of these.
Hold on, we got to go. I'm getting yelled. Could we have a 2,000 point up day on the Dow?
Absolutely, absolutely.
Markets in turmoil.
Markets in a different way.
In a different way, on the upside. Coming up, check out shares of Costco. Obviously on the move after their latest earnings. They have probably been the main retailer sort of at the center of this as people rush to literally just buy 100 rolls of toilet paper for some reason. We're going to talk more about Costco and dive into the numbers there. And another rough day. We talked about it for oil and energy. Is there any opportunity here? Maybe we'll hit that as well. And be sure to always check out our app. Download it today. We're back after this.
ED.
All right, welcome back to Fast Money tonight. Another wild day on Wall Street, escalating economic fears, dragging down the Dow more than 900 points. At one point, we were down quadruple digits, again, more than 1,000 points. We did not finish on our low. If you want to find any kind of silver lining, we did finish down 969 on the Dow. Now, we've got an earnings alert right now, and one name that has been probably more closely tied to the action on the retail side than the other, and that is Costco. Courtney Reagan back at HQ with more on their numbers. Courtney.
Hey, Brian. So Costco beating on profit and revenue for the latest quarter. Comparable sales coming in up nearly 9%. That's including gasoline, which was also above analyst estimates. But I want to point out that's for the whole quarter ending February 16th. Now, Costco also gave some comparable sales for the full month of February, and they did note an uptick in the fourth week through the last week of February associated with the coronavirus and consumer purchasing. So Costco estimates that surge in purchasing added 3 percentage points to make it 12.1% for the monthly comp growth for the full company for the full month of February. Now, CFO Richard Galanti just now, moments ago, giving more detail on the earnings call. Take a listen.
We're getting deliveries daily, but still not enough given the increased levels of demand on certain key items. It's been a little crazy this past week in terms of outside shopping frequency and sales levels, and not only in the United States.
He also went on to talk about how they are going to have to do some limits, but it's kind of going to vary by store and by region, and giving a shout out to his team members for working through all that because it's a very evolving scenario. Now, Costco also said that their membership fees came in higher than what some estimates were for the quarter. E-commerce sales grew more than 28%, and the timing of the week later Thanksgiving, that actually helped bump up e-commerce sales for the quarter by 11%. And that's with the outages that we reported around Thanksgiving and Black Friday, if you remember any of that. So ultimately, the Thanksgiving timing still ended up helping prop up the total company's comp sales again for the quarter by 0.5%. And they are seeing strong sales here in this next quarter because of everything that's going on with the coronavirus. Brian, back over to you.
All right, Courtney, thank you very much. Karen, obviously, Costco's going to see sales boom in some ways, but is it just stealing forward to Courtney's point? What's your take on Costco?
Yeah, I mean, Costco is fantastic. They do well in any market, up, down, flat. I mean, they're just extraordinary. Their execution is always spot on. But for other names, like I wouldn't be buying a 3M because they make masks, or I wouldn't be buying a Clorox because I think just like we might look through, let's say the, Microsoft Cloud growth is slowed down a quarter or two. We'll look through that. But I think we would also look through a Clorox or a 3M because I think ultimately it's going to go back down, and it's expensive to gear up really quickly to fulfill demand that just skyrockets.
I find it fascinating. First of all, Costco, we've been on this for a while. Valuation's going to matter at a certain point. I mean, this is now trading close to 34 times next year's numbers. I mean, the numbers are fantastic. I get all those things. Margins were slightly disappointing, not a big deal. With that said, I find it fascinating that people are stocking up on toilet paper. Either they're Beyond Meat eaters or they know something that I don't know. Either case is not particularly good. I think you are pulling forward. So listen, 325, the all-time high. You've enjoyed the run-up in this stock. There's absolutely nothing wrong with taking profits in Costco.
Just to put a bow on it, if you look at that membership fee, that is like an annuity in the stock, and this stock rebounded really quickly off that 200-day moving average. I still think you're okay to actually buy Costco.
And let's be clear, there's a whole group of stocks people are buying just as like a coronavirus portfolio, small biotech, so just be careful. All right, we've got a lot more Fast Money coming up on this big day for the markets. Here's what's ahead after the break.
It's one of the biggest sectors in the market, and what's happening in tech could be sending a broader signal for where stocks are going. How concerned should you be? And later, an options bet that's paying up big for one of our traders, where he sees stock of Zoom Video going down. We've got that and a whole lot more when Fast Money returns.
right, welcome back. Stocks once again sounding the alarm today about economic concerns. The Dow down at 1 point, more than 1,000 points, finished the day down 969. The NASDAQ was the relative outperformer, falling, quote, only 3.1%. The Dow is actually up 1% for a 12-month period, but another day like today, we're going to wipe out all of last year's gains as well. Now, this extreme volatility probably has you wondering, where are we headed next? How is this possible? Basically, what's going on? Mark Newton of Newton Advisors at the Plasma with the hope, I guess, to figure out what is going on and where we go. Mark.
Thanks, Brian. Hey, we're all trying to understand this new era of volatility. We're going up 1,000, down 1,000 every day. So where do we stand and what's the damage that's been done? You take a look at S&P initially, a couple things come to mind. First, you see that initially when we rallied into these February highs, momentum was actually a lot lower on this move to new highs. So a lot of the broader based equal weighted indices did not make new highs. We knew that sentiment was exuberant. We saw the shift to defensive trading. We saw the overconcentration of a lot of stocks as opposed to the S&P, and all of a sudden Treasury yields broke and S&P broke right with it. Well, we went down to 28.55, which is about 50% of the entire move up since 2018. We've tried to stabilize. It's been a very tentative rally thus far. S&P was down almost 100, but yet we didn't even get down under yesterday's lows. So put that into perspective. The bottom line is that my thinking is we probably get to 31.80 at a maximum, but any sort of rally from here into April likely is going to be something to sell into given momentum starting to really roll over. So if you look at longer term charts, you can sort of put this into perspective. Here's a rally since 09. We really haven't done hardly any damage just yet in the longer term trend. But you see this line, which has really held 4 or 5 times since 2009. And so this area is right down near 2,500. That's a long way away. Initially, what investors want to look at is, do we get down under the lows that were just made last week, 28.55? If so, then yes, there is fear right now. We do have oversold conditions on a short-term basis, but we can't rule out a move down there over the next couple months, particularly if coronavirus starts to accelerate in our country and others. And so, you know, let's take a look at one group that I think is very important, and of course that's technology. Tech actually peaked out in January. Markets moved to new highs, but tech on an equal weighted basis did not. This is the S&P equal weighted technology index versus the S&P itself. So it shows you how tech as a broad-based equal weighted group is doing, not just the FANG stocks, not just the Microsoft and the Googles, but all of them. This started to break down as of last week. So that is a short-term negative. Tech's at 22%. Yields have been pulling back. Obviously, that's affected financials. The broader trend, though, for now is still intact for tech. If we see this start to give way, I'd have a lot bigger concern about tech and the entire market starting to really roll over. For now, this is intact, but we do see that short-term weakness. With that in mind, let's take a look at a stock that I actually like here. I think with all this corona, a lot of us are going to be doing a lot more Netflix and chilling in the months to come. And this is a stock I particularly like. Netflix has held up remarkably well. Stock broke out of this longer-term triangle pattern. It started to stall out a little bit, but it still acts very, very well. So outside of buying Apple and Facebook, I don't care about those as much, but this is a stock that I think makes good sense from how consumers can be positioned, and technically it makes a lot of sense for me as well.
All right, Mark Newton. Mark, why don't you come back and join us over here at the desk? All right, thank you. Now, Steve, Mark just flagged some pretty important levels in the S&P 500. Do you agree? Are you watching those levels?
So I am, and I agree, because I flagged that 28.55 level last Thursday, and that was the level that stuck out to me because it was the October 3rd low. So if you look at that October 3rd low through that prism, that's the level we had to hold. And to Mark, if we break that level, the 28.55 level, I don't know necessarily. So the way I look at it through your lens, right, it's 28.55. 31.80 to the upside, playing around in there for a trading level. How much of a chance do you see us breaking the 28.55 and heading ultimately, because this is where panic sets in, right, to the 23.50 level? That's panic. This is trading. This is volatility. What are the odds of us breaking that 28.55 level? I think they're at least 50%, only because we haven't really seen the stability in Treasury yields, and that's been a major driver of financials to the downside. Groups like transportation are starting to roll over as well. And so, you know, we've seen a decent bounce off the lows, but yet volume was lacking. Yesterday's up day had the lowest volume on the SPYs since the prior Monday. And so it hasn't been a great breadth move. As we saw on that chart over there, technology has been breaking down of late. So that's a concern. If you don't have
financials and technology, that's 40% of the market. So you really need to see some evidence of those groups starting to stabilize. I think before you can see any real rally, we need to see stabilization. There's no need to be the hero and try to pick the bottom. That's the bottom line. I mean, momentum has really started to roll over of late on a weekly basis, and that's definitely something I'm watching.
Yeah, the weightings really have changed. They've changed how the market trades, and we're learning that. We learned it the good way for a number of years. Now we're kind of learning it the hard way. Mark, thank you very much. All right, coming up, speaking of sectors that don't really matter that much, energy stocks getting hit hard in today's sell-off. We're going to break down what might be next for that group, which is only 4.5% of the entire market. It used to be 15% later on. There is something interesting happening, though, in China stocks that has got one of our traders scratching his head and wondering, is there opportunity overseas? Because maybe they're ahead of it. We're going to talk about that when Fast Money returns. Influence. All right, and along with stocks, oil also fell as well, losing another 1.5% today. It is now down 25% this year, hovering around its lows from more than 1 year ago. And oil stocks, of course, they've not only followed, they've led. They've done far worse because the debt load, those stocks still getting walloped on economic slowdown fears. You got too much supply, you got too much demand. I mean, Guy Adami, we could be looking at a situation where there's 3 million barrels a day of excess supply. 3 million barrels a day. That's what, 240 million barrels over a matter of a couple of different weeks. The last time we saw that kind of supply, oil was at $25 a barrel. Would you buy any of the oil stocks?
We've said if you want to play some of these levered names for trades, they're interesting. Oxy, and obviously that was a terrible call yesterday. It's down 4% today. But I will tell you, for the last year and a half, we've been saying stay away from these big cap integrated names. And now, on top of everything, with this whole ESG thing, now that you talk about an exogenous risk, that's the one. Exxon is trading at levels we haven't seen in about 13 years. You probably know the exact date. It's NG. It's not good. So you say it's valuation. Well, that's been the reason to own it incorrectly, literally for the last $25.
BK by BP.
No, BK sold short oil today. On the headlines that OPEC came out, said they want to cut 1.5 million barrels a day.
It's a lot, but it's not a deal yet.
I know, but oil rallied and then failed. So you get what would be good news, bad price action. That's a market that BK wants to short.
There's nothing that seems to be able to rally the commodity. We've seen the cuts. The cuts are useless. When you look at Saudi Aramco, I had a belief that you're looking at the top of the energy market there, because even though it's a small sale, why do they want to give up the goods if they believe that there's greener pastures ahead? I think Guy touches on something that we've been talking about. This ESG investing has taken the legs out of the chemical trade, out of the whole entire fossil fuel trade, and there's something going on. And if oil can't rally, and oil breaks the $42 level, which has been support going back to 2016, you're looking at a world of hurt for a lot of these companies. And to wrap it all up, there's going to be a lot of debt levels that these guys are carrying that they're going to be
But not everybody's got the debt. Not everybody's got the debt.
Doesn't matter. What they've got is
I can tell you, every
ExxonMobil's now
company's net debt to
28%.
EBITDA level almost from up here, and a lot of these names, and I sent out a screenshot, are down 75% this year. Those are the high cost, high debt Bakken.
You know what you
producers,
should be able to
the
buy?
Whitings, the Oasis,
And they're still down.
and Northern Oil and Gas.
And they're still down. All these companies could be great
I'm
companies
talking about
on
Exxon,
paper.
7% dividend yield, not
and
going
down
away.
28%. How many days do you get to lose that?
not
You could lose
I'm
it in a
just
day. No.
pointing it
I know.
out.
I'm
Pointing it
not.
out.
I'm not debating. I'm Sicilian, so everything sounds like a debate for me. But you can't buy these things for a dividend. They're down 28%. The one stock, the one area, should be the refiners, where you actually see input costs coming down. Though that should be a tailwind. Valero down 34%.
What about the
year to date.
midstreamers, the pipeline companies? I know this. There are some midstreamers, like I said earlier, that are able to raise debt. If there's one big one going on right now, I can't say who it is, but there is a market for some of the midstream. We're still moving a lot of liquids.
You're being traded as a blanket over all of these names.
That's my point.
And
I
there's
wonder,
zero-
does that
there's
provide
zero.
the opportunity
Does it-
when literally everyone
Maybe.
just dumping everything?
Do you think ESG investing is going away or getting bigger? My answer is it's getting bigger. And I think these names, unfortunately, there's a lot of great companies within this sector, and I think they're being thrown out with ESG investing.
Who's a great company?
I like the refiners. I like
Like
EOG.
Valero's,
I like some of
EOG.
these E&P companies. I think there's a host of E&P companies that are takeout candidates, but who's going to take them out?
The bigger ones, maybe at some point when they start building windmills. All right, coming up. I'm not kidding. Are you looking for a green shoot in the sea of red? Well, this stock has done well, almost doubling this year. There are some things that are up this year. We'll talk more about the name and the trade ahead. And of course, do not miss our special coverage tonight. Markets in turmoil. Another 1,000-point drop for the Dow, 7 o'clock Eastern time. You can watch it on the app as well. Check it out. We're back right after this. All right, welcome back. Another brutal sell-off hitting your stock investments as coronavirus fears grow into economic fears. But there's one name that has been bucking the trend in a big way. Of course, video conferencing stock Zoom surging higher. More companies cut non-essential travel, and demand for alternative to face-to-face meetings skyrockets. Zoom is up 85% this year. And if you tuned into Options Action a couple weeks back, you saw Options Play Chief strategist Tony Zhang call the breakout. Well, now he is back to explain how you can use options to get in on the stock's perhaps next leg higher. Tony.
Thanks, Brian. So I want to do a look back on the Zoom trade that we laid out on Options Action a few weeks ago. This was a bullish earnings play. Because of the high implied volatility, we were using a call diagonal here to play a bullish view going into earnings. I was buying the March 105 calls for about $8 and selling the February 28th weekly options 107 calls for about $2.15. Here we spent about $5.85, risking roughly 6% of the underlying stock price to take a bullish view into the earnings. Now, the goal here was to allow this February 28th weekly options to expire worthless, and that's exactly what we saw. On February 28th, Zoom was just below that 107 level, and we were able to let those calls expire worthless. And we sent out a tweet the following Monday to turn this long 105 call into a vertical by selling the March 130 calls against it. We collected roughly $4.50 on that call option, which brought our net trade on this particular trade down to just $1.35. So our whole risk on this particular trade was only 1% of the underlying stock price. Now, Zoom reported earnings yesterday and blew it out of the water. 15 cents on earnings versus the 7 cent that was expected. 188 million in revenue versus 176. So as of today, what we saw was that if you did not catch the tweet to turn this into a vertical, your March 105 calls, you would have been able to sell those for roughly about $17, which turned out to be about a 293% gain on your investment, which is pretty good on a 25% move on the underlying stock. But if you were able to make that adjustment, you're looking at almost an 1,100% gain on this particular trade because of the fact that we were reduced the cost of that trade down to just $1.35. And I think this is a prime example of how to utilize options to play a bullish view going into earnings while risking a very small amount of capital doing so.
All right, Tony Zhang of Options Play. Tony, thank you very much. We appreciate that. Well, for more Options Action, of course, tune in the full show tomorrow night, 5:30 p.m. Eastern Time. Coming up, much more on the big sell-off. The Asian markets are about to open. How should you set up for tomorrow? We're going to find out. We'll get those Asian trades coming up in a few minutes. We've also got our Cramer Cam on Mad Money tonight. Jim's take on where to put your money as well. Of course, coming up at the top of the hour. We are live at the NASDAQ, and we are back right after this.
insurance.
All right, the markets are about to open up for the day in Asia. Let's find out their setup. Sherry Kang joining us now with more from Hong Kong. Sherry.
Hi there, Brian. Of course, Asia kicking things off in a defensive mode. New Zealand, the first one out of the gate, down 1.7% as we speak. Australia futures looking very damaged as well, down more than 2% on the SPY futures as well. And of course, when it comes to this particular market, gold stocks could potentially come to the rescue because investors went for the something safer, gold, and that can translate into some resilience in gold stocks as well. But of course, we are eyeing the Japanese yen very much carefully, trading at 106.16. So that means dollar sinking, and investors are going for that safer currency. And dollar is down more than 2% against the Japanese yen so far this year. In the meantime, though, as we are waiting for the Chinese market to come online in about 2.5 hours to go from now here. You know, Chinese stocks actually made up for all the coronavirus related stocks, or losses, I should say, you know, so far this year, earlier this week. So that can actually set a different tone for Asia. Brian?
Sherry Kang in Hong Kong. Give us a look there at the open. Sherry, thank you very much. All right, so what's your take on the Asian markets here, Karen?
Well, the thing that I find so interesting, if you look at the Asian markets, I mean, they've had obviously a sharp fall and then a huge rally. And if you overlay where the coronavirus cases, the growth, once the growth slowed down and it became a little more linear, and then it actually slowed even more, so you had fewer and fewer cases every day, the market their market looked through that and really rallied really hard. I don't know if that, if that means we will as well, because obviously they're throwing everything they can there. But like we said earlier, this is a president who has really, pegged his entire sort of success on how the market's doing, how the economy's doing. I wouldn't be surprised at all to see us throw more than that 50 basis points at this problem.
Yeah, and you look at how the A shares have traded. That's the China A shares, and the ETF for that is ASHR. They had one big gap down and then have rocketed skyward. They look like they want to break out. If you think about what's going on in there, whether you believe it or not, the factories are ramping back up. People are going back to work. So investors are trying to get ahead of that. And I think if there's any place in the world besides gold that you want to be involved in, I think you look at the A shares in this environment.
Amazing, isn't it, that they're the epicenter and their stock market just continues to go higher.
BABA is remarkable quickly. I mean, this stock
name you liked weeks ago.
It's traded remarkably well. So I think Karen's onto something there, Brian.
Not crazy. All right, up next, your final trades. All right, it's a big one coming up tomorrow morning. Do not miss National Economic Council Director Larry Kudlow, first on Squawk on the Street. Tomorrow morning, obviously, is going to talk about the economy. By the way, we got a jobs report at 8:30 o'clock. 8:30 o'clock. It's been a long week. 8:30 tomorrow morning, and nobody seems to care. We're going to talk about, Larry, about all that's going on and what stimulus measures they might be thinking about. All right, time now for your final trade. Let's go around the horn. Steve, kick it off.
Snapchat, my final trade. It was my final trade last night in a sea of red. There was one stock on my screen that was green. It rhymes with app chat. Can you guess it? Snapchat. Bye.
BK.
Yeah. So I think in this environment, the case for gold and Bitcoin couldn't be better. You look at potentially currency devaluations, competitive devaluations. You want to own gold and you want to own Bitcoin.
Yes, the scariest thing you can do is sell puts when you own them. I started selling today. I'll sell it tomorrow. You didn't like them at 14 with the VIX. You can't be a buyer at 42.
The Goldman Sachs upgraded FireEye. They clearly watched the fast money $18 price target. FireEye higher today. FEYE. Brian.
All right, well, maybe the only thing, that app chat or whatever, higher today. Guys, great show as usual. We'll see you tomorrow night. Mad Money with Jim Cramer starts right now.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is to entertain, but more importantly, to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. How worried should you be? 9 business days ago, the legendary Warren Buffett talked on CNBC about the greatness of America and the power of long-term investing. He explained stocks were still the best assets. He pointed out that even if you bought and held during the financial crisis in 2008, the worst possible time, you're up big now. But since Buffett made that call 2 weeks ago, the S&P 500 is down roughly 10%, thanks in part to another brutal session where the Dow plunged 970 points, S&P plummeted 3.39%, and the Nasdaq nosedived 3.10%. Buffett always says that you should be fearful when others are greedy and be greedy when others are fearful. In October of 2008, he published a now legendary op-ed piece in the New York Times titled, "Buy American, I Am." As the Oracle explained, and I quote, "I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So if you wait for the robins, spring will be over," end quote. Now, a lot of people think that was a pretty prescient piece, incredibly prescient. There's one problem. Buffett published that editorial on the morning of October 16th of 2008, when the Dow Jones Industrial Average stood at 8,577. It then actually tumbled to 6,547 5 months later. That was the actual bottom. That's a 23% decline. Now, some could be critical of that because that drop, well, it's not unlike the drop we are maybe having right now since he spoke to Becky Quick a week ago last Monday. Maybe that's the process. Maybe that's even further along. But hold your horses or your bears or whatever and go back over Warren's words again. He wasn't even trying to call short-term bottoming when he wrote that piece. He disparaged the very idea of doing so. Instead, he related that moment to past bottoms, like when we troughed in 1933, or when we looked like we might lose World War II in April of 1942, pointing out that in every case, stocks bottomed before the actual situation improved. Then he lists a series of negatives we ultimately triumphed over. There's oil shocks, wars, Nixon's resignation, multiple recessions, even a flu epidemic, which is a good jumping off point for today, because we're at the beginning of something similar to a flu epidemic, and the experts say it cannot be controlled. You hear it, you read it, I do too. Now, I don't know if they're right. I have my own views about what needs to happen. Say what you want about authoritarians who run the People's Republic of China. Their heavy-handed quarantine is working. This would be a good time to close schools, shut down foreign travel, maybe even needless domestic travel for all I know. And certainly, by the way, cruises. But at the end of the day, I'm not a public health expert. I'm a stock market expert. And when the market's getting hammered, I like to remember what Buffett wrote in 2008, because back then, the solvency of our banks, of our actual financial system was in question. Back then, prominent mainstream economists, and I've read them and read them and read them at the time, were saying we might need to nationalize the banks in order to save them. Yet the government wasn't just slow to act, it was downright negligent. Policymakers, what were they doing? Well, they were paralyzed.
They know nothing. They know nothing. They know nothing.
Arguing that it was illegal to take strong action, or that the moral hazard of bailing out the banks was too great. Better to let the whole system collapse. Even after Congress bit the bullet and passed a $700 billion bailout, the situation was looking grim. Until it wasn't. In March of 2009, Fed Chief Ben Bernanke took bold action, saying he wouldn't let any more banks go under, something he should have done a lot sooner, but better later than never, right? Now, because of tough regulation like nowhere else in the world and prudence, our banking system is the envy of the world, capable of handling far more stress than it could back then, and I believe than it is able to, I think it can handle it now. This time around, though, we have a twofold problem. It's not really related to the banks, even though they act terribly. First, will the travel and leisure companies, or even some mall-based retailers, actually survive? Judging by today's action, the market thinks that's an open question. Same goes for companies that thrive on people gathering together in large groups. Not going to happen during this epidemic. Each day, more and more gets canceled. The second issue is more straightforward. Will you survive? As in, should you just stay home to avoid getting sick? For this, we only have statistics, and the survival stats are actually quite good for most of the population, except for people who are immunocompromised and the elderly, especially older people who are already in rough shape. And those numbers are bad, okay? Let's just call it what it is. They're bad in aggregate. Now, as I walked through downtown today from the Exchange to my office, what did I see? I saw carefree people on a beautiful day, strolling around smiling and laughing, and I think to myself, don't they know what's coming? Haven't they read about the state of Washington, where certain areas almost seem like Wuhan? I mean, don't they know about the yield on the 10-year Treasury hitting record lows? Haven't they heard about the transports? The transports, for heaven's sake. Will they ever be foolish enough to take a cruise again? And here's where I come out. One, there may not be any way to contain this scourge, at least not in democracy. Two, some of us will indeed get sick. I hope it isn't you. I hope it isn't me. And a small percentage will pay the ultimate price for shaking hands with the wrong person. But three, the idea that there's no hope for treatment, that there's nothing to arrest the most serious cases, well, that seems wrong-headed to me. Once you go there, you're betting against the smartest people in the world. Feels like a sucker's bet to me. Even as I worry for myself, for my family, for my friends, I'm not willing to bet against American scientists. I have way too much respect for the people who develop medicines in this country and routinely save lives when we were told over and over again they couldn't be saved. Even in most of your lifetimes, when AIDS was raging, for example, that went from a sure death sentence to a chronic disease. Miracle? No. Brain power, including the brain power of the most important person heading up this fight against this virus, Dr. Tony Fauci. Respect him. Which brings me back to Buffett's words. Where are we in the market right now? Well, we're down a little more than 10% from the high. That's actually not down that much. It's painful, I know, especially if you bought at the high, but it's a much smaller decline than we've experienced when Buffett told you to buy America in October 2008. If you want to sell some stock in the next bounce, and there will be a next bounce like we had yesterday, you got my blessing. Buffett was early last time. He's probably early this time. There's nothing wrong with keeping more cash on the sidelines. Right now, cash is king, until, of course, when it will become pawn again. I recognize the fragility of this moment. For those who pick stocks, this is the time to own. What have I been recommending? Gold, some good staples, mainly food, definitely drugs, some utilities, like American Electric Power, which is on the show tonight. But I also think that it's awfully hard to time a bottom here. While I don't actually think that we're all that close if things keep getting bad, I also don't want to wait too long to put that cash to work. I never like conflating real life and money. But from a financial perspective, the system's a lot stronger than it was in 2008. So if you sell everything, I'm not sure you'll be able to nimble enough to get back in at a lower level. I bet you feel real good for a couple of days. I will say this. If you're worried about yourself, your physical self, you shouldn't have to worry about your money too. Certainly, if holding on to stocks makes you more uneasy about real life, then ring the register on some of your positions for the moment, even if you have to pay some taxes. That's not worth the agita. But the bottom line, I'm going with Warren Buffett. He was dead right in 2008. Even if his timing, let's just say, was ill-advised, maybe left a little bit to be desired, I think he's going to turn out to be right this time too. Oh, we don't know the time. We don't know the level. The disarray is palpable. But as the Oracle of Omaha always says, be greedy when others are fearful. Just please, if you're going to buy gradually on the way down. Be mindful of those nice people out there strolling in the sun today who don't even know to be fearful, and the tens of millions of people just like them. Corey in Rhode Island. Corey.
Hey, Jim, quick question for you
Sure.
regarding Microsoft. If it continues to take a dip, do you think it's worth buying the dip?
I think when you buy a company like Microsoft with Satya Nadella at the helm, and you get it, say it's 166, let's say you wanted to buy 100 shares, and you buy 25 shares tomorrow, and you buy it on a scale down, I think you'll look back a couple years from now and say, wow, I took advantage of one of the few real deep declines. Ravi in Pennsylvania. Ravi.
Hey, Jim, love your show. Thanks for taking my call.
Oh, thank you. What's going on?
Opportunities on booking, Jim. I know it's taken a big hit since the coronavirus scare, and it's near its 52-week low, and I have a substantial position.
Which one was it? Oh, BKNG? No, I mean, that's kind of... Look, I'm a huge believer in buying what I think is down a lot that is not in the blast zone, and you're buying the so-called blast zone with that, and there's no need to. Why take on the hardest when there are lots of very good yielding stocks that I think are, let's just say, allow you to sleep better at night? All right, as the Oracle of Omaha says, be greedy when others are fearful, and that is worth repeating, especially on a day like today. Oh, Mad Money tonight, I'm talking retail in the time of the coronavirus. What determines the trajectory of the sector? I'll tell you why it all comes down to two words. Then the market faced another dramatic sell-off today, but I'm eyeing one stock that managed to end in the green. Don't miss my exclusive with Sangamo. And with utilities on pace for the best week ever, how is a company like American Electric Power faring? I'm talking with the CEO. Stay with me.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This volatility is unheard of, people. Use it to reevaluate your portfolio.
You're the best. Thank you very much for your show and advice throughout the years.
We have your back, and we will get through it together.
Thanks for always being willing to stick your neck out and give us your honest, informed opinion. I want you to know we appreciate you trying to help us out.
I am there for you, all right? These times, I am playing for you. You get every bit of my knowledge. I'm just trying to do my best for you. We always get through these together. Will this time be any different? You want to win in retail? You need to be off price or online. Everything else is in trouble, especially in this post-coronavirus world where things are getting a whole lot tougher for the whole industry. Take today. It's a company called Burlington Stores. I don't know if you shop there. I kind of like it. It reported a great quarter, although its stock ended up closing down slightly thanks to the gravitational pull of the averages. But Burlington, a classic off-price chain, put up 3.9% same-store sales growth. Wall Street was only looking for 2.9. That's a major beat. Throwing some margin expansion and the promise of more down the road. And you know Burlington's got a bright future, even if the next few months might be difficult for the whole industry. It's a buy. On the other hand, there's Kohl's, a more traditional brick-and-mortar chain with an online strategy that's just not as good as Target or Walmart. Kohl's delivered an inline quarter and boosted the dividend. But after rallying ever so briefly, the stock started falling like a rock, including a brutal 6% decline just today. At these levels, the darn thing sports an 8.25% yield. Typically, that would signal that the payout may be in danger, but they just raised the dividend 5%. How's that possible? Simple. Because Kohl's is neither off-price nor truly online, so its stock goes begging, even if it's not financially distressed. And it's not. Hey, same goes for Macy's, at least when it comes to the numbers here recently. So the department store's been shedding assets, closing unprofitable locations, paying down debt, even developing their own off-price chain called Backstage, while cashing in on the cosmetics boom with Bluemercury. And what does that get you? Nothing but losses for those who own the stock. Macy's has fallen so far, now has a 13% yield, which is the market's way of telling you that CEO Jeff Gennette needs to cut the dividend. Would he do that to preserve the cash, even though the company's profitable? Maybe. Certainly not in the plan. What matters again, though, is that Macy's is considered to be a full-price brick-and-mortar business in an online off-price world. Worse, it's mall-based in most of the country and tourism-based in New York. Those two millstones are the last thing a portfolio manager wants hanging around her neck with this virus sweeping the nation. Okay, now contrast that with Walmart. It's got an extraordinary off-price and online strategy that seems to be working. Walmart stock barely got dinged today, down less than 1%. It gives you everything that a stock picker would write right now. It's a double play. Of course, there's some hybrids, too. I like CVS, not because of its drugstore, but because of its Aetna Health Insurance division that's looking a lot more attractive in a world where Joe Biden's the presumptive Democratic nominee. I don't like Walgreens, though, because it's just a drugstore. We own CVS for ActionAlertsPlus.com. You can follow what I say about CVS by joining the club. Kroger's another one that's working. Good numbers today. Really, the stock's surging 8%. I think Kroger's about as close to off-price and online as an old-line supermarket can be. Costco's results were awesome tonight, and that's the place to go if the market crumbles on COVID and COVID-related fears. I'm sure there'll be some profit takers. It's been a horse. Finally, there's the ultimate hybrid, the dollar stores. Dollar General's been one of the best performers of our era. It's incredibly well run and keeps expanding where there's little competition. Dollar General's off-price for certain. I like the model. I like the company. But then there's Dollar Tree. We had them on last night. These guys used to be the king of the dollar stores. It's where I shop until they bought the undermanaged Family Dollar 5 years ago. Since then, it's been rocky as all get out. The stock's down about $2 since the deal closed. During that exact same period, Dollar General's nearly doubled. Is it time, therefore, to take your profits in Dollar General and plow them into Dollar Tree? Not yet. For now, this is strictly a show-me story, as Dollar Tree CEO Gary Philbin acknowledged on last night's show right here. The company's dependence on China is causing real supply chain disruption. Of course, there's also tariffs issues, and that the coronavirus has shut down vast swaths of the Chinese economy. It's not good for them. That said, the dollar stores are certainly the right concept, and if Dollar Tree gets it right, well, you could have a huge gain. But that still needs to be proved, so stay on the sidelines for now. The bottom line, if you want to succeed in retail, you need to fully commit to off-price or online. Everything else is going to have a much harder time in general, especially in the middle of a possible pandemic. And remember, it has more to do with the buyers not wanting these stocks than it does necessarily with how the companies are doing. Okay, I want to go to Lee in New York. Lee.
Hey, Jim. Booyah. How are you?
I am doing well. How about you?
I'm doing great. I want to put you on the phone with my son. He's got a question for you.
There you go.
We watch you guys every night, and I try to teach them the importance of investing at a young age, like you always preach. Here's my son. Hold on.
Okay, thank you.
Booyah, Jim.
Booyah, partner. What's going on?
This is Lou Jr. from New York. I'm 11 years old, and I watch Mad Money every night with my dad. I love your show. Thanks for taking my call.
Thank you. What's going on, friend?
I want to buy my first stock, and my question is about video games. I play FIFA, Madden, and NHL, made by the company Electronic Arts. Symbol EA. With the market going up and down every day, do you think it is a buy?
Kid's got horse sense. I like EA. Actually, candidly, I like Take-Two better. I like Activision better. But you know what? You like the games, you know them, and and that is something that people are going to do. Stay at home. The stocks have been acting very well. I was going to recommend the group again today, so I bless EA. And thank you for the call. Like that kid. Need an assistant right now. Let's go to Will in Georgia, please. Will.
Hey, Jim, you're a gentleman and a scholar.
Oh, boy, my dad always said that to real nice guys. What's going on?
My call is regarding the retail pharmacy stocks. And by the way, I do own CVS. So, year to date, CVS is down 15%, Walgreens down 20%, and Rite Aid is up 14%. I have two questions.
Sure.
First, how on this green earth is Rite Aid up 14% when less than a year ago their stock was at 69 cents and the company did a 20-to-1 reverse split just to avoid being delisted? And they only have 2,000 stores where CVS and Walgreens have more than 10,000 stores each. Do you recommend buying the stock, Jim?
Well, what's happened is that so many people are betting against it that when it turned out to have a pulse, they had to go cover, and they're still doing so. Look, I'm stuck with quality. CVS is higher quality than Rite Aid, but I understand if someone wants to speculate with Rite Aid, they have my blessing. I happen to like my Rite Aid very much, including my pharmacist. How about we go to Jeff, also in Georgia? Jeff.
Hey, Jim. Booyah.
Booyah. Booyah.
Hey, with a good-looking dividend, I'm interested in your analysis of Big Lots, BIP.
Man, they missed so bad. They missed that quarter, and it was disappointing. I got retailers like a Walmart that haven't been missing, or a Costco, by the way. It's reported this evening. And if that stock comes down, it's on profit-taking, and that could be a great place to go. We have to, what I call, high-grade our portfolios in this time of turmoil. Memo to retailers, if you want to win, commit to off-price or online. Everything else, just say it's suspect. Much more Mad Money Ahead, including my exclusive one of the few stocks that actually ended up today. Don't miss my sit-down with Sangamo. Then, as coronavirus panic spreads, and it is, I'm buying one stock many turn to in a panic. Remember, panic's not a strategy, but they do go to Generac. First, after another tumultuous week for this market, I'm taking all your calls in tonight's edition of the Lightning Round. So stay with Craig. This volatility is unheard of, people. Use it to reevaluate your portfolio.
You're the best. Thank you very much for your show and advice throughout the years.
We have your back, and we will get through it together.
Thanks for always being willing to stick your neck out and give us your honest, informed opinion. I want you to know we appreciate you trying to help us out.
I am there for you, all right? These times, I am playing for you. You get every bit of my knowledge. I'm just trying to do my best for you. We always get through these together. Will this time be any different? No. It is time. It's time for the lightning round. One of the seats. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. I'm going to start with Sean in Virginia. Sean.
Booyah, Jim. Thanks for taking my call.
Booyah.
So I had a holding in my portfolio. They've been on your show a few times. Nutanix, ticker symbol NTNX. I bought high and low for an average of about $36 per share. And I have a pretty long time horizon.
Okay.
But in your
Well,
opinion,
you're going to need a long time horizon for that because they missed their quarter very, very badly. And it's not like it's a situation like it's a Dexcom or something where there's use for the product no matter what. I just picked Dexcom as that's an example of a stock that holds up rather well. Let's go to Carol in New York. Carol.
Hi, Jim. First, I just want to say that I think it's likely that you will have saved lives by talking about your virus preparations here and on Squawk. So stay well. Now my stocks. I have nearly 7% of the 10% gold target. The larger part is GLD from about 25 years ago, and more recently I've been buying only Barrick. Is Franco-Nevada a good company
Oh, I like
to add?
Franco-Nevada very, very much. It really is in my sweet spot. Thank you for those very kind comments by what I'm trying to do. I'm tired of this Sweet 15 stuff. But you know what? You got to do it because I do it for you, okay? And I think FNB is a good stock. Greg in California. Greg.
Hey, a big booyah, Jim, from my late father, Tim, who's an avid fan of your show.
Oh, that's so nice. Oh, geez, I wish I'd met him. I'm glad he liked the show.
He loved it. And my question's about Shockwave Medical and what you think about their long-term
I like that. I like devices here. I've been saying that devices are the right place to be. I just actually referenced Dexcom. I think medical devices, gold, pharmaceutical, very good, especially when they're down. Richard in Illinois. Richard. Richard?
Yes, sir.
You're up, Richard. It's Jim. You got him.
I'm sorry. Can you speak a little louder?
Sure, it's Jim. You have Jim on the phone.
Hello?
Okay, this is an ill-advised situation. I think we should go to Scott, frankly, in Texas. Scott.
Yes. Hi, Jim.
Hi.
Thanks for taking my call. Big fan.
Thank you.
Yeah, I was just calling about ServiceNow. I know you're a big fan of the company.
I am a big fan, and I think that Bill McDermott is a bankable guy. Now, understand, even the best ones, like a Splunk, great quarter, down 14 today. Like a Costco, getting hit in the after hours. Anything can have a short-term problem, but I am with Bill McDermott. I am with ServiceNow. Let's go to Chris in Virginia, please. Chris.
Hey, Jimmy Chill. Booyah.
Oh, booyah, my friend. What's going on?
Hey, I'm 33. I've been watching your show since high school. You've really helped me mold myself into a great investor. I'm grateful. Thank you.
Thank you.
I found a company that really seems to benefit from the secular tailwinds of the growing ESG and indexing trends. What's your thoughts on MSCI?
MSCI is run by my good friend Henry Fernandez. He's a remarkable guy. I've been backing him. Yes, he's my friend. He's my friend from real life. He's my friend because he and his wife are good friends with me and my wife, and he does a remarkable job. I've been recommending his stock since I met him, and I'm sticking with it. I met him a long time ago. Charles in New Jersey. Charles.
Hello, Jim.